base case is really that there will be a cut in December, a 25 basis point cut in December.
We have in our baseline that the Fed's cutting to 3.5.
They don't have to go too much further to be at the right rate for this level of inflation.
We're priced for strong growth and additional term premium.
The economy's in a really good space.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday after snapping a 2-day losing streak on the S&P 500 and a 5-day slide on the NASDAQ. Equities resume the decline. We're down 0.4% on the S&P. On the NASDAQ, we're down by 0.2 on the Russell. The small caps getting hammered, negative by 1.1. In the bond market, there's a bid on a 2-year, on a 10-year, on a 30-year. On a 2-year, we're down 5 basis points. Likewise, on a 10-year, that yield 436.28. On this headline out of Europe, Lisa, Ukraine striking inside Russia using U.S. weapons.
Yeah, and there's fear at the same time that you have Russia coming out and saying that they are amending their doctrine, the nuclear doctrine, to basically say that they will retaliate with nuclear weapons if a non-nuclear state has a conventional weapon attack on their land while being backed by a nuclear state. It is a very specific kind of protocol. But the question here is, what does this tell us? A, about the knee-jerk reaction, oil prices up, Treasury yields down, and what does this tell us about the path of travel and how rocky it could be heading into the next couple of
Well,
months?
the path of travel is going to be even more interesting because we have President-elect Donald Trump on the campaign trail vowing to end this war. And right now what you could see is rhetoric and movement, potentially both sides wanting to make sure that they have the most leverage going into what would be end war. But this certainly today is an escalation. Ukraine was given the green light to go ahead, and they did so.
Lisa asked the question, what does it tell us? What it tells us this morning is when things go wrong, people buy bonds, and people buy U.S. Treasuries still. That's what it tells us.
To me, that's my biggest takeaway, because we can discuss whether it's signal, whether it's noise, et cetera. But from a market's perspective, bonds are still bid when there is geopolitical trouble. When there is some sort of sell-off because of a catalyst in equity markets, bonds get stronger. So to me, does this sort of rebuke some of the runaway yields, the new regime that some people were talking about?
Bond yields lower this morning by 5 basis points, right the way through the curve. Elsewhere, looking at foreign exchange, the euro shaping up as follows against the US dollar after a really strong run of dollar strength. Euro dollar 105.63. Lisa, a slightly weaker euro this morning.
This really goes to dollar strength across the board, although at the same time you start to wonder about what kind of impetus there's going to be for some sort of strength in Europe. You do see the dollar bid. You do see some marginal strength, though, in the yen, in the Swiss franc. So again, what are the haven currencies? Although I don't want to get too carried away about calling the yen a haven currency or calling the Swiss franc a currency. Although, good morning, Tom Keene.
It hasn't been much of a haven over the last year at least. Coming up on this programme this hour, Russ Koesterich of BlackRock. As stocks fall on geopolitical risk, we'll speak to John Lieber of Eurasia Group on the race to be the next Treasury Secretary, and we'll catch up with Juckes of SocGen on how much further the Trump trade can go. We begin this hour with stocks edging lower as traders weigh potential Trump policies and concerns grow over the conflict in Ukraine. Russ Koesterich of BlackRock staying long equities. While we think the market will need to digest the post-election rally, we expect stocks to end the year higher. Russ joins us now for more. Russ, good morning to you, sir. We need to start with bad news and the capacity to absorb bad news in this equity market. How great is that capacity this morning?
Well, good morning, Jonathan. Look, we had not had any geopolitical disruptions for some time. And the reality is the market has looked past a lot of the geopolitical risk, whether that was the conflict in Ukraine, the conflict in the Middle East. So there's not a lot of risk premium baked into markets. That said, I'd say as of now, at least, the reaction from markets is fairly modest. The S&P down less than 0.5%, and still near an all-time high. So I do think markets are still focused on the fundamentals unless we see a more meaningful escalation and or a more meaningful move in energy prices, which, as we all know, have been remarkably contained given all the potential for risk in the world.
The same cannot be said for the Europeans. European equity markets are down by more than 1 full percentage point, which leads me to your outlook for 2025. Significantly overweight the United States. Russ, are you just doubling down on U.S. exceptionalism?
Well, we're going with where we see the best companies, I think is the short answer. So there are definitely differences between the U.S. and Europe and Japan. The most obvious a much stronger economy. You're less exposed to some of the geopolitical risks out there, given the huge size of the domestic market. But, a lot of this, you come to the same conclusion, even when you look at the market from a completely bottom-up basis. And we focus on the basics, looking at cash flow, looking at profitability, looking at earnings growth. It is stronger in the U.S. So when we talk about the reaction in Europe, absolutely. Part of that is the proximity to the conflict in the Ukraine. But part of this is the U.S. has just been a stronger market with better earnings and better cash flow.
There is this question, though, Russ, on a relative basis, just whether people are overweighting this idea of a soft landing or even a reacceleration with American exceptionalism, given that pretty much every outlook that we have read so far talks about 10% or more gains in the S&P 500 next year, as well as the U.S. outperforming. At what point do you think this is all baked in at a time where some of the forward looks that we're hearing from companies are not outperforming to the degree that many people were expecting?
So at least I think it's fair. I mean, and there's no doubt the U.S. is the most expensive market. Now, some of that has to do with sector composition, but even when you adjust for that, the U.S. is more expensive. Again, I think it's more expensive for a reason. But here's the sort of the challenge. Generally, when you think about other non-U.S. developed markets outperforming, whether it's Japan or Europe, we all know they tend to be more weighted towards cyclical companies. They generally outperform when you're expecting a reacceleration in global growth. That's not the base case. We do think the U.S. is going to continue to grow at or above trend. But you look at Europe, you look at Japan, you look at China, you don't come to the same conclusion. So while I do think the U.S. is more expensive on a relative basis, it's just not clear. You're going to get the conditions in 25 that would lead you to overweight Japan or overweight European equities, given what we expect of the global economy.
Given all of that, you're not that positive when it comes to the U.S. government debt market, which I find really interesting on a day like today, where you do see that haven bid into bonds.
Yep.
And that isn't necessarily boosting stock performance. There basically is a breakdown in some of the traditional relationship between bonds and stocks that we've seen in the past. I'm just wondering, do you not see bonds as being the sort of haven bid that they have been in the past to the same degree, even if the knee-jerk reaction is the same, that you're seeing signs that people are not necessarily going to continue to feel that way?
Lisa, I think this is like a huge question and underappreciated, because you think about building a multi-asset portfolio, you've always got to ask, what's your hedge? How do you mitigate risk? So a couple of thoughts. I mean, first of all, there are a lot of parts of the bond market we like right now. We like credit. We like securitized. We like the yield we get on those assets. We like the belly of the curve in the U.S. market. We are more cautious on the long end because of supply. But here's the thing. I do think you were exactly right in the lead up to the show. There are conditions where U.S. Treasuries still work as a hedge. They work when geopolitical risk is the catalyst for a sell-off. The problem is when you think about economic risks, for 10, 20 years, Treasuries worked so well because the economic risk was almost always concerns about a recession, concerns about slow growth. And now we've got a two-sided economy. Many of the concerns we have going into 25 are, will inflation be too sticky? Will it reaccelerate? And if that's the risk you're looking at, or that's the risk you're looking to hedge, then yes, I don't think treasuries are the best way to mitigate risk in a portfolio. There are other strategies you can use. So when you think about are treasuries going to work or not, a lot of it comes down to what are you most afraid of? I agree with you. If it's geopolitical risk, then yes, treasuries probably do work in the short term.
Well, it is geopolitical risk today, and we're going to have a change of an administration with two hot wars currently taking place. So what would you advise to clients? Where should they hang out?
So I think there are a couple things. Part of it obviously is how much of a risk you think you're going to have from Europe and the Middle East. Again, I think one of the more important things, other than a real escalation, is going to be oil prices, which has so far remained contained. We do think the U.S. holds up better than Europe. We do think that you still focus on quality companies. In other words, part of hedging that portfolio is owning companies that are going to hold up better during disruptions. And then the other asset we've been looking at, which I think also works with the geopolitical sort of risk off, is gold. Gold has the benefit of scarcity. It's been an asset that's worked under geopolitical risk situations for a long, long time. And if part of also what you're concerned about is long-term U.S. debt, this is an asset that you can print more of. So that's another place that we're having, a position in the portfolio.
You've noted that it's a valuable diversifier. Is this a day like today, you look at it and you say, actually wish I had more?
Well, whenever you have a movement, you always wish you owned a little bit more. I do think Gold is, there's a certain portion you want in the portfolio. It's probably more in the low to mid single digits. But yes, I do think if part of what you're worried about is that very hard to quantify geopolitical risk, which again really hasn't disrupted markets, but it's still out there. It's still lingering, particularly with the change in administration. Then I do think gold is one of the things you own in the portfolio to help smooth the ride.
Just before we wrap it up, Russ, I want your opinion on the race to be the next Treasury Secretary. We've had a series of guests. Heard from Carl Bass yesterday saying that maybe it's already having a market impact. Evercore's Sarah Bianchi saying exactly the same thing as well. Russ, do you share that view? Is it starting to have a market impact?
You know, I'm not sure. And it's hard because there are a lot of things to disentangle. Certainly, one of the things that's disrupted the Treasury market, I think more than the race for the Treasury Secretary, are concerns about, is the Fed going to be able to cut as much as the market expects in 2025? And is inflation going to continue to grind lower? Right now, I think that's probably a bigger move of what we've been seeing in Treasury markets over the last few weeks.
Hey, Russ, appreciate the update, sir. Thank you. Russ Koesterich there of BlackRock, Evercore's Sarah Bianchi, Carl Bass, Jim Reed of Deutsche Bank this morning saying the same thing.
So there is probably some sort of read-through. It's hard to sort of draw a line specifically for a certain person or a certain news story among the multitude of news stories that have come out that could have led to a sell-off. But there's a feeling that maybe this kind of sequencing isn't going to be the same as many people thought in terms of tariffs, in terms of pro-growth. And that, I think, is getting people a little bit concerned.
It's a conversation we'll have in just a moment with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. An update on the geopolitics. According to media reports, Ukraine is conducting its first strike using U.S. long-range weaponry within Russian territory. Moments before that, Russian President Vladimir Putin pushed ahead with a pledge to update Russia's nuclear doctrine. Putin's decree allows Russia to respond with nuclear weapons to conventional attacks. The Kremlin said it will view aggression against itself or its allies by a non-nuclear state backed by a nuclear power as a joint attack. Boeing plans to lay off more than 2,500 workers across the country. That, according to federal filings and a union official. Nearly all of the impacted workers were cut on Monday in Washington and South Carolina. Overall, the plane maker plans to cut 10% of its global workforce in the coming months. Sources tell us that President-elect Donald Trump's transition team is considering former Fed official Kevin Warsh as Treasury Secretary and hedge fund manager Scott Bessent as the director of the National Economic Council. Trump was expected to make the decision on the Treasury job last week, but infighting between Bessent and Cantor Fitzgerald CEO Howard Lutnick reportedly irritated the incoming president and delayed his decision. According to people familiar, Lutnick is no longer seen as contender for the role. That's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, it's Trump's test for Treasury.
Trump wants someone in there that's going to continue to move stocks higher. Yes, Trump wants someone in there to focus on the worrying trends in the bond market. Who we put in as Treasury Secretary is going to be vital to the stock markets, the bond markets, and our prosperity.
The race for Treasury Secretary continues. We'll get the view of John Lieber of Eurasia Group in just a moment from New York City this morning. Good morning. Live from New York City this morning. Good morning. If you are just joining us, just a touch of risk aversion across the screen today. Check it out. Equities down by 1/3%. A bit in the bond market. The news out of Europe. Ukraine striking inside Russia using US weapons. The first thing that Lisa said when she came into the studio earlier on this morning, check out the move in bonds.
Well, and the reaction function, do we learn anything from the idea that you are seeing that haven bid in the heels of some kind of geopolitical risk? I guess the counterpoint to this, if I were having an argument with myself, which I do every day, is that gold is having its best day in 3 months. Is the gold reaction outsized relative to the bond reaction as sort of its haven function? I don't know. These are the questions that I'm asking simply because have we really changed and entered some sort of new regime?
There's always a risk of overthinking it on a morning like this morning.
You don't say.
Gold is up by 0.9%. Treasury yields are down by about 5 basis points. Under surveillance this morning, Trump's test for Treasury.
Grow our economy and also to protect our economy from state actors that say have malign intentions. Yes, Trump wants someone in there that's going to continue to move stocks higher. Yes, Trump wants someone in there to focus on the worrying trends in the bond market. Who we put in as Treasury Secretary is going to be vital to the stock markets, the bond markets, and our prosperity.
So here's the latest this morning. Donald Trump's transition team nearing a decision for Treasury Secretary, reportedly leaning towards former Fed Governor Kevin Warsh. Investor Scott Bessent now in talks for a separate position as the director of the National Economic Council. John Lieber of Eurasia Group writing the infighting and the delay in announcing the pick indicates that cooler minds are not prevailing in Mar-a-Lago. Despite her appointment as Chief of Staff, Susie Wiles does not appear to be exerting an orderly influence on the operation. John joins us now for more. John, welcome to the programme, sir. I just wanted you to breathe some life into that quote that we just shared with our audience. Do you think this is Susie Wiles' fault for not being able to handle the situation, or is it just Howard Lutnick, who's meant to be chairing the transition, inserting his own name into the process that has really complicated things?
Well, no, I think it's Donald Trump's decision-making style that's the challenge here. I mean, Lutnick's been an ally of Trump throughout most of the campaign here. He was the co-chair of the transition process. And in a normal world, that kind of puts you in a pole position to to kind of choose what job you want. And Trump, for whatever reason, or Trump's allies don't seem to like him all that much. There seems to be concern among a lot of people in the Trump camp that all of the Treasury people who are being considered, who have Wall Street ties, are just not MAGA enough and don't seem to, in particular, have enough support for Trump's tariff policies, which is, of course, reasonable if your concern is overall U.S. economic growth. And that, I think, is what's delaying here. So it's hard to blame it on anybody except for Trump himself. This just seems to be how the guy makes decisions.
Right. And according to my reporting, Howard Lutnick is no longer in the running for Treasury, so they're going to have to find a home for him somewhere else. But he has been irritating a lot of people within this transition. You say some of this comes down to tariffs. Don't they need someone at Treasury who could be a regulating force to, say, Robert Lighthizer, who they're going to put somewhere, whether that's back at USTR or taking on this new role as a trade czar?
Yeah, that's certainly my perspective, and I'm sure it's the perspective of a lot of viewers watching this show, but I think that our perspectives aren't important here. It's Donald Trump's perspective that matters, and they got elected with a mandate to increase tariffs, to do more, to bring production back to the United States, even if that means raising costs for American businesses and American consumers. Lighthizer one of the few people that survived a 4-year term of the first Trump administration and remains influential in his policymaking thinking. And so I think tariffs are an incredibly important policy initiative for Trump himself and for his transition team. And they're not looking for somebody who's going to push back. They want somebody that's going to implement this agenda. And that's what the search is all about.
So if they want someone to implement that agenda, how do you see Kevin Warsh at the Treasury being the answer? Because he has been a supporter of free trade, and you can just see over the course of the last 24 hours, every op-ed this man has written that has been an individual that has been anti-protectionism.
Yeah, sorry. When I say they, I mean the Lighthizer people who I think are close to Trump and are the ones that are driving all the challenges finding a Treasury Secretary. I don't know where Warsh fits in here. I think that he had been named in the past as a potential Fed chair. His name coming out of kind of in the last minute here as a potential Treasury Secretary indicates that there are some people in Trump's orbit who are pushing a more kind of Wall Street aligned type person for this role. But I don't know, and Warsh has been doing all the right things to kind of get ingrained with Trump's family and has been doing the right things to get his name in front of Trump for a while now. I just don't know if he solves your Howard Lutnick problem.
So according to sources I know, it's Howard Lutnick is out. So now we have Scott Bessent. We have Mark Rowan of Apollo, who's set to go meet with the president this week. Kevin Warsh will be meeting with President-elect this week. And then, of course, there's this dark horse of Senator Haggerty, who the president has a very good relationship with. Out of all those people, who can both be acceptable to MAGA, but also seen as welcoming by Wall Street?
Yeah, I think one thing you got to think about here from Trump's perspective is who's kind of the central casting kind of Treasury Secretary. Warsh certainly checks that box. Haggerty does a little bit too, right? He's kind of an authoritative figure. He's got foreign policy experience. He's got a great business background. So when I heard that name, that actually helped make them a little bit more sense than some of these other names. I think he's also proven his ability to kind of navigate the Trump world. And he's done that by hiring a bunch of people who are aligned with Trump in his Senate office. And, he did serve in the first Trump administration. He was a contender for State Department. He obviously was passed over for that. So putting him at Treasury does seem to help potential helpful compromise between the varying wings of the Trump camps that are fighting over this right now.
As we watch the chess pieces being moved on the board, there's this real question about whether the priority here for the Trump administration will be to shake things up or whether to prioritize markets, whether to prioritize a response that is positive with respect to stock markets and maybe even, to some extent, bond markets. Are we getting any signal about that, especially when Axios is reporting overnight that Matt Gaetz, who was being nominated for Attorney General and had a lot of pushback from people within the Republican camp, that Trump was personally trying to make sure that he got through?
Yeah, I mean, you look at some of these other picks, they don't look like they're being done mindfully in a way that's trying to send a signal to markets. They look like he's trolling. I mean, there's no other way to explain the Matt Gaetz pick. I think Tulsi Gabbard is for National Intelligence Office. Like, she's not somebody you'd put in charge of America's intelligence apparatus. Gaetz has been on the wrong side of law enforcement in the past, not exactly somebody you'd pick to be your top law enforcement officer. So I just don't see this as being an orderly process that is dictated by kind of policy outcomes. I see it as, Trump making up his mind at the last second and doing things that are going to be continually unpredictable. And this is just the world we have to live with for the next 4 years.
Well, John, exactly to that point, and it brings us back to the Treasury Secretary. Is that the reason why there is so much emphasis being placed on this key economic rule? That if you have whatever you want to call it, in your words, trolling of the American people, some of these other picks that are causing some dissent, even within Republicans, that if you have a Treasury Secretary that is heralded by Wall Street, that can sort of abnegate some of the other signals. Is that kind of your read on the situation?
It could kind of abrogate some of those other signals, but I think the larger signals here at play are going to be what policy direction they choose. And so when the tariff announcement comes next year, which is going to happen, there will be higher tariffs on China. There will probably be higher tariffs on other countries and potentially the whole world as well. Then those are going to send a much larger signal to Wall Street about what his intentions are than who he ends up picking as Treasury Secretary. And those are the more worrisome signals that the market's going to have to think about, because that's the thing that's going to end up affecting economic growth and the cost of goods.
So, John, I totally agree with you. Can we finish there? Because I think this is so important. The primary objective of tariffs. In Trump's first term, he talked of reciprocity. In Biden's term, we talked about things like national security objectives, protecting domestic labor and industry, all of those things. It feels like this time the primary objective is just to raise revenue to offset tax cuts. How different is this approach going to be?
Well, I mean, I think you heard the president talk about this at the Economic Club. I think it was in Detroit, where he talked about, the fact that the tariffs are effective at bringing business back to the United States. And I think that's really what this is about. The revenue is kind of a secondary benefit, but they do see potential to replace some of the income tax with the revenue from the tariffs. So that's potentially an offset for extending the Trump tax cuts. That's kind of on a different channel, though. I think the tariffs have a momentum of their own. Even if they end up raising very little revenue, they'd probably do it anyway. And the goal here is to move production back to the U.S. And I think fairness is a part of that. But I also think that, they think that the U.S. is getting a raw deal. And that's been something that Trump's been very consistent about. Yep. And now I think in this administration, you're going to see less pushback against that, no matter who they install at Treasury.
He's been consistent on that matter for several decades. John, thank you, sir. John Lieber there of Eurasia Group. I think we can all make a case for Mark Rowan, for Senator Haggerty, for Scott Besson. Who am I leaving out?
Kevin Warsh.
For Kevin Warsh. I think we can make a case for all of those people. What's really interesting to me, and I think for all of us, is how the market's going to interpret that selection. You can go back over history and select certain quotes from a Kevin Warsh that say that he's for free trade and against tariffs. Neil Dutta of Renmark, who joined us later, very different take. Because he wants the job as Fed chair, I think that will make him, Kevin Warsh, more prone to reinforce Trump's worst impulses on tariffs. That's a different take from Neil.
Especially at a time where Neil is also talking about how he tended to be hawkish when he was on the Federal Reserve and more inclined to actually combat inflation by raising rates. Again, mixed messages. You raise a good question. How does the market respond?
We'll keep coming back to this story, including some exclusive reporting from Anne-Marie in just a moment. Coming up on the programme, the latest from Europe as Ukraine launches its first strike in Russian territory with Western-supplied missiles. That conversation up next. David Costa, Goldman Sachs, out with a new outlook, the art of the deal. You get it? 6,500 on the S&P 500, the year-end target for 2025, implying about double-digit upside on the S&P 500. Equities pulling back this morning by 0.5%. On the Nasdaq, we're down by 0.4. On the Russell, we're negative by 1.2. Bigger risk aversion coming out of Europe this morning. In the bond market, you'll see it plain and clear. The 2-year yield is down by 6 basis points. The 10-year is down by 5. The news out of Europe. Ultimately, the first strike we've seen inside Russian territory by Ukraine using Western missiles.
After the U.S. said that they could, and that this actually has yielded some response from Russia with them changing their nuclear doctrine to say that they would retaliate against a major conventional weapon attack on their soil by a non-nuclear state if that state was backed by a nuclear state. A question here we can get into the tit for tat. Either way, you are seeing that haven bid at a time where some people had questioned whether bonds still would respond in this kind of way.
See it in bonds, see it in commodities, gold tire, see it in foreign exchange as well. The yen, the Swissy, outperforming in G10 against the stronger dollar. The euro a touch weaker. Euro dollar right now, 105.50. We're negative by 0.4%. Under surveillance this morning, sources telling Bloomberg that President-elect Donald Trump is leaning towards former Fed Governor Kevin Walsh as Treasury Secretary. Hedge fund manager Scott Bessent now in talks for a separate position as the director of the White House National Economic Council. Anne-Marie, based on your reporting, what have you learned in the last 24 hours?
So potentially this could be a pairing they're looking at. Of course, we still need to see how Kevin Walsh does when he goes down to Mar-a-Lago and has an interview with President-elect Trump. Of course, they know each other, but this is for a different job. Scott Bessent is also still seen as a candidate for Treasury. So when you look at Treasury, there's still 4 candidates in the race. Scott Bessent, Mark Rowan, Kevin Walsh, and of course, dark horse Senator Hagerty. And what's interesting here is that Howard Lutnick is now out of the race completely. So he caused a lot of tension because he's the co-chair of the transition, but now he's out of the race. People who are still on Team Bessent, I have to say, Neil Dudd, you guys were talking about him. He said this to me yesterday. He quipped to me. We had a quick chat. He said, honestly, it takes a special person to be able to navigate the personalities of Donald Trump and George Soros.
So Bachelor Take 5, right? This is basically where we're at. There's a larger question, and John, I think that you crystallized it beautifully when you were saying the purpose of tariffs this time around. Is it going to be a negotiating tactic? Is it going to be to try to retaliate or make sure that there isn't necessarily the same kind of unfair playing ground? Or is it different? Is it about raising revenue? Is it about potentially bringing business home? And ultimately, the person who he chooses among this panoply of options will underscore that. And to me, I think that is going to be the market implication at a time where a lot of people think this is just going to be a tit-for-tat negotiation. And frankly, a lot of businesses are paralyzed right now, waiting to understand exactly what kind of regime they're going to be walking into.
Are they handing out roses in Mar-a-Lago? That's all I want to know.
They
Is that how they
haven't
select
yet.
people?
Well, I mean, they haven't yet. They're being brought back, and there's
What's his
sort of
name?
this
Jesse
question.
comes out and says this is the final
Exactly.
rose. Is that how this works?
I think so.
If you don't watch, don't worry. We'll move on very quickly. Let's talk about how this might be received. And let's take a big step back at the same time as well. It is November 19th. The election was 2 weeks ago. This has moved very quickly. It's quite breathless. And I understand a lot of people are taking a step back themselves and saying, what's the rush? We've got some time to appoint the right person. What is the rush? This became slightly messy. And I want to be precise when I use the word messy and what I'm talking about here. It's unusual to see someone like an Elon Musk, who's been very close to Donald Trump over the last few weeks, the last several months, go out on Twitter, on X, over the weekend and be quite forceful about who he would like to see as the Treasury Secretary. It's the way this sort of played out publicly, I would say, that's got a little bit messy over the past few days.
And also, why did Elon Musk go out and do that? Was he pressured by someone else? Because it doesn't seem to me in my reporting that this was a directive from President-elect Donald Trump, which is why it feels like it has gotten messy, because you have the co-head of the transition that should be vetting everyone, trying to also vie for the job, a very competitive job. You know, this is one of the highest positions you can have in U.S. government.
And these are high-caliber candidates. Senator Hagerty, Mark Rowan, Kevin Walsh, Scott Bessent. These are like tip-top, high-caliber candidates.
Yeah, you raise a good question, though, in terms of why has it gotten so messy, at least in public perception and public kind of dissent. And to me, that actually raises a bigger question, which is where is the central force in the White House to make a decision? And these are all qualified candidates, but there are nuances that have a pretty big policy implication around the edges in terms of how tariffs are going to be used and how they view growth versus inflation.
There's a short, very simple answer to that. It's the Oval Office. And I think it's going to be pretty clear for us all to see over the next 4 years. Let's turn to this story. The DOJ is seeking to force a sale of Google's Chrome browser. Sources telling Bloomberg the department is asking a judge to impose AI and data licensing requirements on the company. Google's saying the proposals would harm consumers and developers. Anne-Marie, that stock is down 0.6%.
So what's interesting about this case, it was filed first under the Trump administration. Then the Biden administration took it over. And now this is one of the most aggressive remedies we could see since 2 decades ago when it came to Microsoft. So potentially, if they're able to do this, this would be really a warning shot across the tech space.
How consistent do you think this is going to be across administrations when we get a change at the top of a certain group overseeing all this stuff?
FTC, DOJ, who is going to be overseeing this? This is a huge question mark, which once we get the Treasury pick, we can actually see some of these other jobs filter out, SEC as well. I think you have to remember, Trump wants deregulation, but at the same time, he certainly wants competition in big tech. He made that very clear to our colleagues over the summer when he flip-flopped on his stance on TikTok. He doesn't seem to like TikTok for national security reasons, but he understands the point of it because he said, well, if you don't have TikTok, then what? It's all Mark Zuckerberg. And you have to remember those comments from J.D. Vance, Senator Vance, who's going to be VP Vance. He says that Lina Khan is one of these few individuals that is doing good work and had to do her work with big tech.
It's only been 2 weeks. You talked about that. But there is this question, the longer this goes on.
It feels a lot longer than 2 weeks.
It feels a lot longer than 2 weeks.
Trump news cycle.
There's been a lot going on. But if you're a CEO or a CFO of a big tech company, or something that it depends on big tech companies, how do you make longer-term decisions with the specter of some of this regulatory overhang and potential antitrust activity?
Before the election, any moment you see that might be viable for your company to have a conversation with President-elect, when was then a candidate, you make that call. Google CEO making that call. Hey, your McDonald's stunt was a huge hit on our Chrome website.
I think a lot of people made that call over the last few months. Alphabet in the pre-market is down 0.6%. Elsewhere, the main event in financial markets worldwide developing about 2 hours ago. Ukraine media reporting the country carried out its first long-range missile strike on a border region in Russia using Western-supplied missiles. This coming as Russian President Vladimir Putin approved an updated nuclear doctrine expanding the conditions for using atomic weapons. A real escalation in the past few hours.
This is a real escalation. Physically, from the Ukrainian side, in terms of using these missiles, the United States gave them the green light, and they did so. And then the rhetoric coming out of Moscow is also interesting. This change in how they view the use of nuclear weapons. Now, Putin said in September he was going to do that, but since we've seen this escalation potentially that they view from the West, he came out and changed this decree. In September, he said, quote, aggression against Russia by any non-nuclear state, but with the participation or support of a nuclear state, read between the lines, is proposed to be considered as a joint attack on the Russian Federation. You just see the escalation, and this comes at a time before potentially you have President-elect Donald Trump that wants to force these two sides to a negotiating table.
I think we've seen two issues around escalation over the past few months, and you've been covering this story. The reported use of North Korean military personnel in this war, an escalation. This, another one in the past few days. How do you think President Joe Biden is going to justify this at a time when the American people have voted for a leader who's basically said he wants to end this war?
Well, he dragged his feet when it came to this decision by allowing Ukraine to use these weapons. I mean, this was the top hot question we were asking him over the summer at the NATO conference. He is going to justify this by saying this is not aggression. This is Ukraine's ability to defend themselves.
Let's get to the latest over in Eastern Europe. Joining us now, I'm pleased to say, is Bloomberg's Piotr Skolomowski, joining us from Warsaw. Piotr, welcome to the programme, sir. Do you see this as a new phase in this war?
It definitely is. Obviously, what we're seeing today is a follow-up to what Joe Biden did, which he gave permission to Ukraine to use those weapons, long-range ATACMS, which obviously allow Ukraine to strike targets inside Russia. The permission was limited in its scope. It was only limited to Kursk region, where Ukrainian forces have taken part of it, but in response to the fact that Russia is sending North Korean forces as well, Joe Biden allowed Ukraine to use those weapons finally. And we didn't wait very long. Overnight, apparently, according to a report in RBC Ukraine media outlet, that attack happened. We have no confirmation from Ukrainian side, although what we're hearing from Ukrainian journal staff is that there was an ammunition warehouse that was hit in the city of Karachev, which is about 70 miles inside Russia, but they wouldn't say what sort of weapon were used. So there's definitely that. And yeah, it's all happening. It's also quite symbolic, because what we're seeing is that it's happening on the 10th on the 1000th day of the invasion, since the invasion started. So what we're seeing right now is the escalation on both sides. Both sides are trying to gain some kind of an upper hand before Trump comes in and his administration takes over.
Ukraine has been firing homemade drones deep into Russia for months. What makes this so different?
Obviously, I mean, it's in a way, it's something that that Ukraine has been pleading with Biden administration for months right now. It in a way is something that obviously Biden has shown as a bit of a red line, right? I mean, obviously those red line has been moving, but in this way, I mean, if we read it in the context of the fact that this revised nuclear doctrine was just signed by Putin, it sort of pulls West deeper into this conflict. So that's why the context of signing this doctrine makes it more significant at this point.
We've seen Ukraine really beg for this ability from the West, from President Biden, this entire year. Why did Biden decide to do this now, give them the green light?
Well, it's a good question, obviously, to Joe Biden himself, but it seems like he's basically at this point free to do that, given that, you know, it's the new administration that will come in. But obviously, the official reason, or what we've been hearing, is that it's the involvement of North Korea that changes sort of the calculus in this situation. And even today, when President Zelensky was in European Parliament addressing European lawmakers, he said, at this point, what we're seeing is about 11,000 North Korean soldiers in Russia that ready to go into Kursk to support Russian forces, but this number can move up to 100,000 at some point. So, and Kursk is important. It's important for Russia. It's sort of a bargaining chip if at some point it comes to some kind of peace talks and negotiations. That's something that Zelensky could use when they sit to the table and start talking about a peace or a ceasefire.
So, Peter, is this the way to look at it, that essentially this is trying to grab back enough land to basically lose less when there is some sort of ceasefire, some negotiation early next year?
Indeed, yes. And obviously the fact that they have now more force to bear and to protect themselves, it gives them, it sort of secures their position slightly. Although at the same time, what we're also seeing is that, you know, on the front itself, it's Russia has been making a lot of small incremental gains across the whole front line. At the same time, it's all happening at the huge cost, human cost, apparently or reportedly. Russia is now losing about more than 1,000 people a day, which is just incredible number of resources are being thrown at this war. So at some point, you can imagine that, you know, we get to the point where both sides are just exhausted and they have to sit down and talk.
Shocking numbers. Piotr, thank you, sir. Piotr Skolmowski there of Bloomberg, happy to lead some of the coverage out of the region this morning. The equity market is negative off the back of some of these headlines. We're down by 0.4%. Talked about that bid into the bond market. You see it pretty clearly. 2s out to 30s in treasuries, yield to lower across the board. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President-elect Donald Trump has chosen former Congressman Sean Duffy to lead the Department of Transportation. Duffy represented Wisconsin's 7th District in Congress for 8 years after gaining fame on the reality television show The Real World. Under Trump, the department is expected to shift its focus away from bike lanes and mass transit and towards highway widenings and building new airports. Some earnings for you this morning. Lowe's shares lower by nearly 2% pre-market. That despite a third quarter that topped estimates and a forecast bumped. However, comparable sales did fall 1.1% with softness in DIY and bigger ticket demand. That was partially offset by storm-related sales and its pro category. Home Depot also last week said that hurricanes and warm weather helped to drive demand. SpaceX is expected to launch its Starship mega rocket into space this afternoon. It follows a successful launch last month that saw the rocket's boosters caught in the air by giant metal arms. If all goes according to plan, today's launch will also demonstrate a catch landing. Starship will also perform new maneuvers during its re-entry before splashdown in the Indian Ocean. President-elect Donald Trump is expected to attend the launch in Texas. That's your brief. John.
Hey, Danny, thank you. Appreciate it. You know, when we first started covering these things, I was like, I just don't get it. It's pretty cool. It's pretty cool.
I mean, it's like the ultimate baseball mitt. It's like these iron claws. It just comes down and catches the rocket. I think it's pretty awesome. I do. I actually track it all.
I'm just happy President-elect Donald Trump will be there because it means the Treasury story, I think, takes a breather. If he's out of Mar-a-Lago, he goes to Texas.
Let's announce it there, because that would be interesting, wouldn't it? Rockets taking off. Haggerty.
Stop.
Whoosh.
Here's a rose.
Up next on the program, the strength of the Trump trade.
What we did need to price was a pro-growth environment where you're going to see deficit spending, deregulation, some offsets from tariffs, but how far can that really go becomes the question. When we stack it up, it looks like a pro-growth environment.
Like a really expensive gender reveal. Okay. Except for Treasury Secretary.
Okay, all right.
Too far?
So there's
Too
like
far.
a balloon?
Too far.
And it
you
pops?
see, you like him now.
Yeah.
Yes, there we go. From New York City, a beautiful morning. Good morning. Live from New York City, welcome to the program. Here's a snapshot of things right now cross-asset. At 4:20 Eastern time, a headline crossed the Bloomberg terminal, so about 2 hours and 20 minutes ago, saying that Ukraine has made its first attack inside Russia using Western-supplied missiles. And this is the market reaction. Yields are down 5 basis points, the 10-year 437. Equities a little bit softer, we're down 0.4%. Under surveillance this morning, the strength of the Trump trade.
We're still digesting what the possibilities of outcomes could be for the Trump administration. And there are wide-ranging expectations, and so much is in the detail, so much uncertainty. I think what we did need to price was a pro-growth environment where you're going to see deficit spending, deregulation, some offsets from tariffs, but how far can that really go becomes the question. When we stack it up, it looks like a pro-growth environment.
So here's the latest this morning. Some of those Trump trades are losing steam as the post-election equity market rally stalls and the bond market sell-off stabilizes. Kit Juckes of SocGen writing, it's impossible to say that the Trump trade is now fully priced in, but we must be getting close. We still can't see much reason to take the other side of the trade before the end of the year. Kit, helpful as always. Welcome to the programme, sir. Kit Juckes of SocGen. Kit, let's build on some of that. As we've looked at the FX market over the last several months, at the end of the summer, we had this big dollar long that we started to eat into. Things started to get short. And then we started to pile up this big dollar long all over again. Kit, can we just start with positioning in foreign exchange? What does it look like now?
Well, we're building up a dollar long. It's not as big as it was, although, you know, we must have built some more up since last week as well, because the market sort of kept on going. So, yeah, the market is long of dollars. People have got carry trades back on. People have got U.S. exceptionalism trades back on in the general sense. You can see it across a bunch of pairs. Although, you know, again, this morning adds a completely different sort of geopolitical dimension to it yet again. But let's go with the market isn't necessarily as long dollars as it was at its peak, but it's getting there.
You said there's not really a reason to fight it into year end, and yet you do think that people are actually underestimating the number of Fed cuts and maybe overestimating the number of ECB cuts. At what point will you get conviction to basically overweight the euro at a time where pretty much everybody has left it for dead?
I think if I imagine myself sitting on a proprietary trading desk in the days when those things existed in a big way, would I, as my bosses were trying to sort of rake together the money to pay bonuses out next year, would I be taking a big counter market bet just before Thanksgiving? I think if it went wrong, I'd be in deep trouble with everybody I knew. So, and that's my sense. Is it looks as if it's gone a bit too far, but it'll probably last. I mean, it's also worth saying, right, that the day to sell the dollar in 2016 was Christmas Day, not Thanksgiving. So it kept on going all the way to the end of the year and then unwound itself in January, February, March, with, I should add, a market that got itself excited about an ECB pivot that never happened on that occasion. But so, no, I can't see a strong enough catalyst to fight it, but you can't keep on pricing in the same thing over and over and over again. There has to be a limit somewhere.
Okay, so basically you think that there is going to be this sort of grind stronger in the dollar. Is there a threshold at which those people might say, okay, I understand, I want my bonus, this has worked, and yet I can't really stomach any longer getting long?
Look, I think the trader is probably not the person driving it, but we still see signs that the carry trade from in dollar yen, for example, has been picking up. There are still people seeking yield out there who look at the level of yields on treasuries and think, I'll have some of that. There are still people who, if you get a back off in US equities, are thinking, yeah, I'll have a bit more AI exposure or a bit more US equity exposure because it's outperforming. So we haven't stopped the kind of sticky long-term flows still continuing, and that may be what's grinding us higher. But I'm surely, it's got to be pretty slow moving from here until the end of the year.
Kit, which currency pairs do you think best exemplify the Trump trade? So many of them, but the currencies that have been beaten up, maybe from where you're sitting, the Canadian dollar is perhaps the Trump trade exemplified because it captures exposure to the Far East. So it correlates, the Canadian dollar correlates with the Chinese yuan, which is clearly in the headlights of the Trump trade. And obviously the growth comparison between the United States and Canada is a pretty big deal as well. So maybe that one. So we're above 140 again in dollar Canada. We're up in territory. We haven't been much higher than this since, 2001, give or take. So maybe that's the one that's the neatest way of seeing how much we've put into this. And also the fact that USMCA has to be renegotiated potentially in 2026. Kit, when you look at potentially the Treasury options to lead the Treasury Department under President-elect Donald Trump, do any of them signify to you what the direction of travel might be for the dollar?
Not necessarily. The sort of the least positive kind of person you could appoint there would be the most kind of, Jay Powell, here's a Republican who won't be offered that job, but, someone who is an ex-Fed person or very economics person, someone who's not got an axe to grind beyond running the economy sensibly. But in the end of the day, the US dollar's really done well over the last few years because the US has adopted much more accommodative fiscal policy than most of the rest of the world. And on the other side of that has adopted a tighter monetary policy. I can't see a candidate for Treasury Secretary who's minded to tighten fiscal policy anywhere. So none of them's going to be negative.
Certainly didn't hear any of that on the campaign trail. Kit, thank you, sir. Kit Juckes of SocGen on the latest in foreign exchange. That dollar long back in the summer. Do you remember that?
I did.
It all changed very quickly for about 2 months. And then we seem to be back where we were. All over again.
Because all of a sudden we're rethinking once again Fed rate cuts and how many there can be. We're rethinking America first and what that means for the dollar. And we're rethinking the strength of the U.S. economy and all that, put that together. And you get to that trader who's heading into Thanksgiving and wondering, does he really want to go against everything and say to his boss, I think now is the time to be the outlier.
Anne-Marie said this a few times. People, policy. It's really important. But I think we can all make one big assumption. There are no big deficit hawks right now about to come into power in the Treasury anytime soon.
No, and of course, you really can't be, right, when you're trying to push through your principal's economic agenda. When it comes to tariffs, though, and this is an interesting point you were discussing with John Lieber, the fact of the matter is it can be a carrot and stick approach. We're going to put tariffs on you because we want to bring production back to the United States. And guess what? If you do, only then are we going to try to push through this 15% corporate tax rate. Because that's the one with the asterisk, and that asterisk is made in the USA.
That conversation will continue in the next hour on Bloomberg Surveillance. Drew Pettit of Citi will be joining us around a table. We'll get the perspective of Neil Dutta of Renmac on the race to be the next Treasury Secretary. We'll catch up with Joe Feldman of Telsey Advisory Group as we wait numbers from Walmart. And we'll speak to Ed Al-Hussainy of Columbia Threadneedle. Lisa said it a few times already this morning. Check out the bond market. When bad things happen, you're still buying treasuries. From New York, this is Bloomberg.
The election is not what's going to drive markets in the long run.
Investors think that the stock market, whether it's going up or down, has a real leash on the president. I don't think that that's true.
There might be some more policy uncertainty, but I don't think Trump, who probably campaigned on a better economy, wants to see the economy go into recession.
You still see investors trying to rotate within equities rather than wholesale coming out of equities.
I think the market will be okay as long as it's a growth story.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Two things to watch at the top of this hour, the risk aversion and the reason behind it. One, Two numbers from Walmart about to drop this hour. Look out for headlines in just a moment. Let's start with the price action. Equities and then on to bonds. Equities right now, negative across the board. We're down by 0.4% on the S&P. On the Nasdaq 100, we're down by a quarter. In the bond market, a little bit of a bid. You see it across the curve. 2s out to 30s. Yields are down by 3 basis points on 2s. We're down 4 basis points on 10s. On 30s, we're down 3 to 457. The headline across the Bloomberg terminal about 3 hours ago, around 4:20 Eastern time, speaking to a strike by Ukraine inside of Russia using U.S. weapons, Anne-Marie, an escalation in the last 24 hours.
An escalation. The United States has given Ukraine the green light to do this. This was on the border of Ukraine and Russia. We are hearing from the Russian Defense Ministry coming out and citing that there was these ATACMS. They say 5 of those missiles were shot down. But this is an escalation at a time, Jonathan, when you have an outgoing U.S. president that gave this green light and an incoming U.S. president that campaigned on the fact that he wants to end this war. How much of this is leverage and intimidation as well from the Russian side with this new decree out on nuclear posturing? How much of this is potentially to get them to a better negotiating stance at the table?
That's the first story. Here's the second. Walmart numbers just dropping. And Lisa, right now that looks like a beat on the top and bottom line.
Yeah, raising their full year adjusted earnings per share $2.42 to $2.47. They previously saw a range of $2.35 to $2.43. You go through comp sales in the United States, removing gas up 5.5% versus the estimate of 3.8%. There were some signs that maybe this isn't some sort of gangbusters excitement around holiday shopping. Full year net sales up 4.8% to 5.1%. So yes, climbing, maybe not necessarily going gangbusters. But if you want to read on the U.S. consumer, the early look from Walmart is it looks pretty good. And that's what's being read through to the stock market.
Where is the growth coming from? This from the team here at Bloomberg. A lot of that growth was driven by upper income households making $100,000 a year or more. We do this every time Walmart numbers come out. If Walmart's doing well, how's the country doing?
You know, honestly, I think that Walmart's getting a fuzzier read on a lot of things. First of all, it's important to note that it's not just higher income individuals going down the ladder and trying to get a deal. Walmart is also catering more to higher income individuals by selling items that are higher end items. So that's number one. Number two, Walmart is also gaining share from the likes of Amazon with their online platforms. I want to see the breakdown with the online apparatus. They also are creating their own shopping network. So what is Walmart? Is it the same company that it was 5 years ago? And I think that's important to understand whether this truly is a read-through to other retailers.
It's changed a great deal. Target reporting a little bit later in the week. Walmart in the pre-market up by 3.7%. Coming up this hour, we'll catch up with Drew Pettit of Citi as stocks move lower on geopolitical tensions. We'll speak to Neil Dutta of Renmac as the Trump Treasury saga drags on, and Joe Feldman of Telsey Advisory Group as big box retailers report results throughout this morning and over the next few days. We begin this hour after a Tesla-fueled tech turnaround helped snap a 2-day losing streak. Drew Pettit of Citi writing the following. Market action last week reflects how its participants feel. Exhausted. Earnings have been solid. We got the beat and hold we expected. The Mag 7 continued to provide cover for earnings deterioration in the other 493. Drew joins us now for more. Drew, good morning. It's good to see you.
Well, thanks for having me back in.
Some more numbers on the board. 6,500 over at Goldman, 6,500 over at Morgan Stanley. Year-end price targets on the S&P for 2025. What are earnings doing? What's the earnings outlook look like?
I think pretty good. Look, can't comment on the specifics this morning, but look, it's a good example of we're getting beats, and even though we are getting cuts for full year, you're starting to see people kind of move past some of the malaise, starting to think about maybe next year. There are some really good earnings revision stories that are hidden underneath the index level. Honestly, a lot of it has to do with some types of secular trends like e-commerce, for example, and operating efficiency. But overall, we really do like the earnings picture.
What's driving that earnings picture? Is it better top-line growth? Are they defending margins? What are they doing?
So defending margins, but how is what's really interesting. So the S&P 500 has a lot more operating leverage than we kind of realize. It's not your average business. There's so many companies that are growing the top line 1-2%. You're seeing earnings expand 4-5-6%. That's not necessarily as buyback driven as it used to be. But what's happening is you're seeing sales increase at a faster pace than employee count. And that gets really, really obvious in some of the winners within a lot of sectors and some of the sector leaders as well.
This is the productivity story, essentially, that people are becoming more efficient and that you're using technology to make people more valuable per unit that they end up selling. But there's a real question of whether we're kind of hitting a limit here. And that's something that you kind of feel why people aren't going to 7,000 next year or maybe 7,500. But there's this feeling that maybe we're not going to get the upside revisions that can really beat that much more. Are you sympathetic with that?
So it's a little bit tough to extrapolate this on the revision side because there's always this bias for downward revisions in the United States. The analysts here are optimistic. So the trend is always start really high, let's work our way down. The difference is with some of the really good earnings momentum story, we're starting high and we're not really working estimates down as far as we normally do. So I think on the operational efficiency side, we talk a lot about tech and leveraging people, but there's a lot of like low-hanging fruit that we think still can get picked. So right now we're talking about AI and all these big productivity stories, but designing a product that fits in a smaller box that requires less shelf space, that you fit more in a container and ship, these are all pennies, and really good operators are finding these pennies. So the Mag 7, information tech, comm services get that leverage, but even looking at something like financials, they've had a lot of operating leverage in the past year as well.
So are those the sectors that you're most excited about? Or are there sectors that you don't think are benefiting from these same efficiencies in the same kind of way?
Yeah, those are the sectors we like the best.
Okay.
And that's where, again, like our whole thesis this year around stock picking and sector selection has been operating leverage. So you came off a year where you started to see some tailwinds after working through 2022 and issues. And this year was about operating leverage and follow through. And I think the winners, even within sectors, have shown that.
5-minute conversation on the equity market without a single mention of policy from the Donald Trump administration. Any underlying assumptions about policy and how important is it to you? We're all obsessing over the moment over the future of the Treasury Department. Does that all matter to you?
It does to some extent on what it's going to signal. But I'm going to push back on something I heard earlier on the show. I don't think CEOs and C-suites necessarily just sit there and go, we're just going to have to wear this. This is going to suck. We can't do business. They are investing in secular trends. I know I see you laughing and I'm teasing.
No, I wasn't saying that I'm saying that there is a paralysis in terms of how much to expand in certain places because of a lack of certainty of national security and a certain question around how things will be dealt with on an antitrust level. That said, it's still people are still operating their business. Do you disagree with that?
Partially. If you're doing a big investment in something, here's the weave we were talking about earlier.
Yeah, carry on.
But it is funny. If you're doing something that's big and transformational, yes, you're probably going to pause before you get a little bit more policy clarity. But what I think is really interesting, there are secular trends that politics, they might change that slope very marginally, but they're probably not upending it. So that's the type of investment you can keep doing. And that comes back to tie this all together. If I have operational efficiencies I can gain, I'm going to push on that lever. And I think good businesses are still doing
Drew,
it.
we're 2 weeks out from the U.S. election, and you already said market participants are exhausted. That was your earlier note this week. There's exhaustion. We saw RFK be announced for the Department of HSS. And guess what? Pharmaceutical companies sold off. How much is what happens in Washington or right now Mar-a-Lago going to be impacting specific industries?
That's where we get back to the weave here. And the other side of this, pharmaceuticals, they're going to have their issues. They're going to have to think about how they can actually get growth and change the sentiment. When we talk about exhaustion, we're talking about really high sentiment. You're pricing in all of this good news, tax breaks, deregulation. You're starting to run out of good things to find. And now the news cycle is getting a little trickier because we moved from U.S. election to, is the Fed going to cut? Now we're sitting here with geopolitical tensions again. I said we were exhausted last week. I don't think it's going to get much better this week by the looks of things.
Well, at what point does the market start, and I guess they're doing it today when it comes to geopolitics, but some of the other provisions that a Trump administration wants to go after, tariffs potentially day one, when does the market actually start to price that in?
I think when we finally get a little bit of policy clarity. So tariffs, a little bit messy because it's tough for equity markets to price that in before we figure out what FX markets are going to do. if you had a 10% tariff, but then you whack the currency down 10%, does that really have an impact on gross margins? And then on the other side, in Trump v.1, 90% of exemptions on tariffs were granted to U.S. companies. So back to, we need a little bit of policy clarity to finally price that in. That's a very complex subject that a lot of clients are asking questions about right now.
So when you put the weave together, it sounds like you're incredibly bullish and that you're not necessarily seeing the uncertainty that a lot of people are seeing. So I know Citi hasn't come out necessarily with their next year forecast, but can you give us a sense maybe of what the number might rhyme with and kind of whether you're equal weight or whether you're market weight?
So fundamentally bullish. I'll be very clear there. No ifs, ands, or buts. I think a lot of secular trends are very interesting. A little concerned on how much growth we're pricing in. So a little bit cautious on valuation. How we handle that is we like the growth side of the market, especially communication services, and you see the price action today. That's your macro hedge. That's doing better than Russell 2000, but we like pairing that with cyclicals as your valuation defense. So we like that pair. Let's just skip over defensives. Don't think they actually provide defense.
Smells like 6,400. Maybe. All right, maybe. Maybe. Drew Pettit of Citi. Possibly. That's just me saying that. That's not what they're saying. Wait for the big unveil. Coming to a news programme near you. Let's get you an update on stories elsewhere this morning. Is it 64? Maybe. Let's get you Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Russian media confirming reports that Ukraine conducted its first strike using U.S. long-range weaponry within Russian territory. Russia says that their defenses responded to the missiles dubbed ATACMs. The move comes just as Russian President Vladimir Putin pushed ahead with a pledge to update Russia's nuclear doctrine, allowing Russia to respond with nuclear weapons to conventional attacks. The Kremlin said it will view aggression against itself or its allies by a non-nuclear state backed by nuclear power as a joint attack. A check on Walmart shares, those higher pre-market by 4%. It posted a beat on its top and bottom lines. Walmart boosted its outlook for the year, citing strong demand from U.S. customers across the income spectrum seeking value. Households making $100,000 a year or more drove a significant portion of the company's growth, with customers buying more at each visit. Walmart also saw strong growth in e-commerce. Online sales now total about 8% of its total business. According to people familiar, Apple has increased its offer to invest in Indonesia by almost tenfold. The hope? Persuade the government to lift its sales ban on the iPhone 16. The U.S. tech giant will invest almost $100 million in the country over 2 years. Indonesia's Ministry of Industry hasn't made a final decision on Apple's newest proposal. That's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Just want to triple confirm that outlook from Citi is not out yet. No price target just now on the S&P 500.
Yeah, but blink twice if it's 6,400.
Up next on the program, Trump's latest Treasury contender.
There seems to be concern among a lot of people in the Trump camp that all of the Treasury people who are being considered who have Wall Street ties are just not MAGA enough and don't seem to, in particular, have enough support for Trump's tariff policies.
The view from Dutta of Renmac up next. Equity futures recovering. Check out shares of Walmart in the pre-market. Some of the why for you. Walmart up by close to 4%. Lisa, it's a beat and a raise.
Yeah, although when you start digging into the internals here, hard to see whether this really is some sort of macro story versus a Walmart story. Yes, they are seeing sales sizes get bigger. They are seeing more people who earn more than $100,000 spending more money. These are the items that are selling well. AirPods, televisions, and tires. Put together a macro narrative from that one. Go for it.
AirPods, if it was its own company, would be absolutely humongous.
Yes.
Seriously.
Especially for all the people who lose them and they kind of go bad after a year, and all of a sudden you need to upgrade to something.
I have 3
noise
pairs.
Canceling.
I've had 5 pairs too.
I mean, it's ridiculous.
That sounds like a complaint for another day, given the threat of nuclear war that's taking place right now.
way to put me in my place, John. Yeah. Thanks.
We've got space to joke still. Let's turn to the bond market. 2-year, 10-year, 30-year. Yields are lower today. You see this on a 10-year piece. 436.87. There is some risk aversion out there, a real escalation over in Ukraine as Ukraine strikes inside Russia using US weapons. More on that story later in the program. Under surveillance this morning, Trump's latest Treasury contender.
There seems to be concern among a lot of people in the Trump camp that all of the Treasury people who are being considered who have Wall Street ties are just not MAGA enough and don't seem to, in particular, have enough support for Trump's tariff policies, which is, of course, reasonable if your concern is overall U.S. economic growth. And that, I think, is what's delaying here. So it's hard to blame it on anybody except for Trump himself. This just seems to be how the guy makes decisions.
So here's the latest this morning. President-elect Donald Trump's transition team reportedly considering naming former Federal Reserve Governor Kevin Warsh as Treasury Secretary and hedge fund manager Scott Bessent as Director of the White House's National Economic Council. Neil Dutta of Renmark writing, I have reservations about this. Warsh's endgame has always been Fed Chair, not Treasury Secretary. More importantly, because he wants the job as Fed Chair, I think that will make him more prone to reinforce Trump's worst impulses on tariffs. Neil joins us now for more. Neil, how much weight are you putting on this decision? How important is this one decision to you and the team to really get a deeper understanding of where the emphasis of this Trump administration will be?
Well, I do think it's more important than last time. And if you recall, the last time Trump was president, the sort of framing, as I recall it, was the Republicans in Congress will sign him bills, and then he will send him bills, and then he will sign them into law. But this time, there's a lot more momentum behind Trump himself, right? I mean, he's the one that is got elected, had coattails and so forth. And, the policy, I think, is coming more from the White House. And, as a result, I think this being one of his first major economic decisions, I think it'll set the tone for kind of the economic management of the country and the policy for the next several years. So I do think that, the stakes are somewhat higher now than before.
One issue you take with is that you think that Warsh would not be able to reinforce Trump's worst impulses on tariffs. Who do you think could do that? There's about 4 names that are floating now, according to sources familiar to me and my colleagues. One of them we just discussed, Kevin Warsh, but of course there's still Scott Bessent for Treasury. There's Mark Rowan, and then dark horse candidate maybe Senator Hagerty.
Well, I mean, I do think that it's going to be difficult for anyone to get in front of the Trump train with respect to tariffs. I think if I were talking to President Trump, I would say, would you want someone who's hawkish when the economy is weak and when the economy is strong? Is that what you really want as your Treasury Secretary? I think someone like Lutnick, frankly, would probably be, someone that would reinforce the worst impulses on tariffs. And as I say that because, one of these candidates actually rallied with President Trump at MSG, and that was Lutnick, I believe. So, look, I mean, I think there are problems with all of these candidates. We've said publicly at Renmark that if we had to pick, we think Scott Bessent would probably be the best choice of the names reported. But the Treasury job is a job that, requires a lot of knowledge around macro, markets, finance, and you need to be able to navigate personalities. And I do think that Mr. Bessent's someone that's navigated personalities as wide-ranging from George Soros to Donald Trump.
So you think this is also a
qualification in my book?
So you think it's also a personality issue? If it was to be Scott Bessent or he was to go into the NEC, what do you think his view is on tariffs? Because we've gotten almost 2 different versions, whether or not he's for blanket tariffs or he thinks they need to be used as a negotiating tool.
I think he'd be a reliable advocate for the president's policies to use tariffs as a way to re-level the trading relationships between us and our major trading partners. He said as much in a recent op-ed. So, look, you're not going to find many people out there that are willing to put the sort of tariffs in place that President Trump ran on during the election. That's just a reality. And if you find some of those people, they may not even know sort of the ins and outs of some of the financial markets that they'd be overseeing, right? I mean, so it's a matter of their expertise in some of these issues. So that's a stretch. But I do think that he would be someone that would, carry out the spirit of the president's plans.
Neil, there is this question about taking Donald Trump seriously but not literally. And that seems to be what markets have been doing, trying to basically take the pro-growth impulses and saying that a lot of the other stuff, including tariffs, were negotiating tactics. From your perspective, from RenMac's perspective, if Donald Trump does choose somebody who is viewed as more hawkish when it comes to tariffs, would that change your view materially for the U.S. economy and U.S. markets?
No, I mean, I think the hawkish tariff stuff is already in the price. I mean, remember, when we talk about tariffs, it's also important to remember that we're talking about relative price changes, right? I mean, if you look at what happened last time, prices rose for the things upon which the tariffs were put on, and prices generally fell for other things. Okay, and we're in a situation now where Trump inherits an economy where nominal growth is generally slowing down. So if tariffs are put on imported goods, I'm not sure which goods those would be, the prices for those goods would rise, but the prices for other goods would be coming down because nominal growth wouldn't be accelerating, and at least not immediately.
Well, okay, but given that, Neil, then do you really think that the market is actually responding to this Treasury Secretary pick? Because according to what you just said, if it's not going to have that material of an impact on your economic outlook for the United States or the market outlook, then why are people making such a big deal about it?
Well, I mean, I think it's about, well, remember, Lisa, the market did rise very sharply following the election of Trump, right? And I think part of that is about confidence. It's a confidence game. And Trump himself has said that, or at least according to press reporting, that the way the markets react to the announcement of his Treasury Secretary is an important signal. They have said that. I think that there's potential for confidence to not be reinforced with this potential pick.
Neil Dutta, we appreciate your time, sir, and your thoughts. Neil Dutta there of RenMac on the race to be Treasury Secretary. Just to echo some of Neil's thoughts there, because I think they're really important. This is a really different moment for this country. We're going to see some massive policy shifts with global consequences, which could feed back negatively into US markets. And you need someone in the Treasury seat, I think, who's a market specialist, I think now more than ever, just to echo where Neil was going with this. So if we just take a big step back once again and acknowledge once more, it's only 2 weeks since the election. If you go through the short list, these are really, really, really high caliber individuals, from Kevin Warsh, Scott Bessent, Mark Rowan, Senator Hagerty, all of the above. But I think this is probably a moment where you want a market specialist, which speaks to Bessent, which speaks to Rowan, just that little bit more.
And not just a market specialist in terms of the United States. We're talking about a global market specialist. If you're going to be the individual that is going to oversee not just the sanctions and the $28 trillion of debt, but also how these tariffs are going to be used and what happens if there's a reciprocity on the other side and some of those other countries start to put up their walls.
Just remember, managing the maturity profile of treasuries over the last year has been a big, big deal in fixed income markets.
Oh, yeah. There's been an accusation that the focus on the short end in terms of issuance has been to avoid disrupting the long end. The importance here is nuance and the sensitivity to it.
Not much of that at the moment, Bramo. Not much of that. From New York, the latest on retail, up next. Check out equities right now. We are down by 0.25% and off session lows on the S&P 500. On the Nasdaq 100, we're down about 0.1%. The Russell really recovering. We're down only 0.5%. We were down by more than 1% earlier on in the session. With your morning movers, let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, good morning. Let's just pick up on that, because what you have had this morning is a refresher crash course in knee-jerk headline reaction trading. You're right in terms of that Russell, but also take a look at this. Lockheed Martin still up 0.7%. It ratcheted higher this morning. Defense stocks all went bid as well. Again, on these headlines, Ukraine hitting deeper into Russia and Putin signing off on a new nuclear response. But here's the thing, according to BCA, we had Marco Papich sitting down with us this morning. Be wary of these knee-jerk trades in the first instance. They can injure your bigger macro trade. Roll it over, have a look at the macro personification of the United States of America. You're shopping at Walmart. Even if you're making more than $100,000 a year, you are coming in here in size. You're buying. I like what Lisa just said. Airports, televisions, and tires. I don't quite know where the tires fit in. But to be fair, this is about raising the guidance for the year. Families are seeking value, leaning into the holiday period, and online business is up 27%, and it's now just under 20% of their overall business. So, all bid there. I'll leave you with a pretty stunning performance, microcomputer. How do you stay on NASDAQ? You say to the board, we're going to give you our filings. We're going to be clear and deliver clarity. They've hired a new auditor, BDO, and so you have this massive ramp higher. This stock, it's the darling of the data centers. 39% return in 21, 87% in 2022, 246% return in 2023. But it is all about transparency. Can they do that with a new auditor in BDO? Good morning. I'm off to buy a few tires.
Manus Cranny, you enjoy yourself. Send us some photos. Thank you, sir. You can see Manus in a Walmart buying tires, can't you?
I'm actually looking at the tires, and they're all on sale, and that's probably why. And I will just say that, especially ahead of winter time and all-weather tires, so you don't have to change them every 6 months. I imagine a lot of people are trying to upgrade.
There's a very original Walmart update for you this morning. The stock is high. We'll come back to that story a little bit later, maybe absent the tires. Under surveillance this morning, Trump's Treasury pick still in flux. Sources telling us here at Bloomberg the president-elect is considering former Fed Governor Kevin Warsh for the Treasury Secretary role and hedge fund manager Scott Bessent as NEC director. Worth pointing out that things are still pretty fluid.
They are still pretty fluid, but they do see potentially this could be a pair-up. Again, we need to see how Kevin Warsh does in terms of sitting down with President-elect Trump when he goes to Mar-a-Lago for this job. We know that he's interviewed with Trump, but that was for a Fed chair job. And to Neil Dutta's point, that does seem to be the job maybe he wants. We should note Howard Lutnick is out of the race. So the producer that wanted to be a star, this is not where his star is going to land. Maybe they will find another home for him, but it's not going to be a Treasury. So that leaves you with 3 top and then 1 dark horse. Scott Bessent, Kevin Warsh, and of course Mark Rowan of Apollo will also be going down for an interview. Senator Hagerty potentially could be an individual that's interesting because
that name just won't go away, will it?
It won't go away because, one, he is viewed by the business community as a very good pick. He's viewed by diplomats as a very steady hand. Of course, he was the ambassador to Japan under Trump's first administration. And he's going to get the applause of senators on both sides of the aisle.
We were due to catch up with the senator from Tennessee this morning. We're working to reschedule that conversation later in the week. Maybe we've got news. Who knows? Let's turn to this story. Russian state media confirming reports Ukraine conducted its first strike using US long-range weapons within Russian territory. Russia's saying their defenses responded to the missiles, shooting down 5 and damaging another. And that really is the 2-part story to the session so far, Bramo. On the one side at 4:20, a really negative headline, a sign of escalation, equities down. Then reports that the damage was limited. On the other side, just a few hours later, equities started to rise just a bit.
There's a feeling that maybe this is the tit for tat ahead of some broader negotiation. But you start worrying about nuclear war, and all of a sudden people get worried and they pile into treasuries, which is what people were looking at. What the market is saying right now is a couple things. Number one, treasury is still a haven bid when all is said and done. So is gold. Oil prices go up. But people are not that worried that this is going to escalate because this doesn't feel, as much as the rhetoric is existential and as much as maybe we can't joke about certain things because there is this existential risk, there isn't necessarily a real fear of this turning into.
Well, there's other tea leaves to read, and that's to your point, this idea that maybe this is all negotiating to get to the negotiating table, to make sure that you have the best hand you can play, because President-elect Trump says he wants to end this war. What else did we see recently? Olaf Scholz, the Chancellor of Germany, I would argue probably from a position of weakness, given the fact that he is dealing with a political crisis in Germany, but called Zelensky. And part of that was to say maybe you should be open to a negotiation. But the fact of the matter is there is escalation today because we have ATACMS, given the green light by the United States, being used in Russian territory on the border. And then the rhetoric heated in Russia in the sense of this edit of a decree when it comes to nuclear.
President-elect Donald Trump wants to end this war. Does this help him or hurt him?
I think this helps him in the sense that you do see rhetoric rising because you can potentially see why. You're going to see both sides want to do this because they want the best hand they can play if they are forced to a negotiating table.
Those two headlines this morning, whipsawing equity markets one way and the other. This has helped equity markets get off the lows as well. Walmart delivering better than expected third quarter results. The company boosting its outlook for the year on strong demand from US consumers searching for value. We'll get results from Target tomorrow morning. That stock at the moment for Walmart, Lisa, up by a little more than 3%.
Yeah, and I'm looking at it and I keep wondering, what is Walmart? Is Walmart still a retail company, or is this actually now an advertising company, a marketplace, also, some sort of media company? Because they're expanding in all these different ways and they're really taking on Amazon. I do wonder how much their narrative shift is really affecting the way people treat this as maybe not as much a macro story as much as what we were just hearing about, which is the efficiencies of scale, the efficiencies of technology, and the efficiencies of being the biggest behemoth in the pool.
Let's have that conversation right now with Joe Feldman of Telsey Advisory Group. Joe, welcome to the show. Following those numbers from Walmart, I'm going to steal Lisa's question to kick off the conversation. What is Walmart these days, and how much has that company changed?
Yeah, so Walmart is a terrific retailer that's grown its ecosystem, and it's much more than just a retailer these days. I think, they have become more similar to what an Amazon is in terms of offering, a marketplace, offering advertising, and effectively selling across the board online, in stores. And they've grown their whole ecosystem as a result. They've been able to capture a more affluent consumer. They're still satisfying that lower income consumer that needs the low prices on a day-to-day basis. And so they're really serving the American customer very broadly right now. And this quarter was very strong, and I think it just shows those results.
Yeah, Walmart's online sales now represent about 18% of the company's business. They also have things like coupons for loyalty members to places like Burger King. I'm just wondering, Joe, if there is still the read-through from a Walmart results to the rest of retailers. Do we get a real sense of the consumer and the health therein?
Yeah, no, I do think there's still a good read-through. I mean, Walmart is still the largest retailer in the world, and, they are still, especially in America, the largest, and they're capturing customers day to day. I mean, around 2/3 of their business is groceries. And so they're seeing that customer come in once a week. And their grocery business was up mid-single digits in the Walmart US operation. So the customer is still coming in on a regular basis. They're seeking value. Their private brands have done well. As I said, they've captured a more affluent consumer. So it just seems like I do think it's still a good read on the broader consumer. But what's really interesting here is they do so much more now than just sell stuff out of the store. And I think that's what's gotten investors very excited. And you can see the strength and the market share gains that they've had with the reports that they just did this morning.
Is their gain taking away from Amazon, or is it basically taking away from Target, from all the other retailers that are a bit smaller and less advantaged than they are?
Yeah, I think that the big guys kind of go to battle with one another, but the share gains are coming from all those smaller regional local players. I think that that's where you still see a lot of it, because Amazon's operating quite well. I mean, they have very good earnings recently, and they're expected to have another good fourth quarter. I think Target's been operating quite well. We'll see tomorrow for sure, but I would expect, some similar directional trends that we got out of Walmart today. But it's really, as you go down, the dollar stores have been under a lot of pressure this year. A lot of people believe that the Walmart's taking share from some of the dollar stores. I think that's somewhat true. Again, they are capturing a more affluent consumer. So that's coming from somewhere, maybe the traditional grocer out there. So the prices are so good at Walmart. They're so sharp. And what's amazing is they're driving their business with increased traffic, increased unit sales. Those are the good things you want to see. It's not just ticket's part of it, but it's really because they're getting more people in the door more frequently.
Joe, I want to talk about strategy. Is the new strategy to start Christmas shopping in October next year? Is that what we're going to be talking about?
Yeah, I think we may be already happened this year, quite honestly. I mean, with Amazon Prime Day back in October, and then Walmart did an event right around it, Target did an event, Best Buy, everybody else in retail tried to capture that week. And, we've been seeing Black Friday ads for quite a while now. And, it started to kick in even a little bit more just yesterday. We noticed a lot more emails and pushing that. So that holiday season has definitely gotten stretched out. Now, this year's kind of unique because there are 5 fewer days between Thanksgiving and Christmas. So that does compress the season a little bit. And I think that a lot of the retailers tried to take advantage by elongating it on the front end. But it just seems to us that you're going to see this continue for some time now, where mid to late October is when things start, really, for the holiday season.
Joe, we're all living it. We're hearing the music. We started hearing the music about a month or so ago. Joe, I wanted to talk about a theme that we've been discussing on this program for quite a while now. It's how battle-hardened, how battle-tested these companies have been, the retailers, over the last, let's say, 8 years. They had the pandemic in the Trump first term. President-elect Donald Trump will get a second term. They could face the same again. The tariffs, the pandemic as well. When they manage inventory, Joe, how have things changed over the last several years for these retailers, given the tests that they've had, the unique tests over the last decade?
Yeah, one of the biggest things that's changed is that the supply chain finally normalized in the past 2 years, let's say. And as a result, the retailers have been able to get back to more of that just-in-time ordering. And we've seen the inventories be run very lean, really, for the past year and a half for many of the retailers. You saw that again today, even with Walmart, where they don't need to necessarily order early. Now, when events happen, like, the East Coast port strikes that happen, and by the way, we haven't resolved that. The contract has not been signed, and next round is January. The retailers did bring in inventory a little bit ahead of that. I know there's concern if and when the new tariffs get put in place by the new President-elect Trump. I think, there is some concern that we might see some inventories get accelerated prior to those tariffs. That makes sense. The retailers have definitely gotten smarter about how they're ordering, where they're ordering from. They've shifted their distribution or their supply chains beyond China. They're much stronger in other parts of Southeast Asia at this point and other parts of the world. So there's a little less reliance than the first go around with the tariffs back in 2018, 2019, but it's still going to be a big pressure, and it's going to likely pass on to the consumer. And we see it as somewhat of a tax on the consumer, quite honestly, because it's likely to raise prices. All the retailers are telling us they're going to have to raise prices at the end of the day. Maybe not for the full amount of the tariff, but definitely for a good portion of that. And we see that as an inflationary impact as well.
Joe, just to build on that, there is this feeling, and every time we see a tariff announcement, retailers sell off the most. And they're viewed as sort of ground zero when it comes to potential companies that are most exposed to tariffs. Are you saying that maybe that's already baked in to some degree and that people have basically prepared for that and these retailers have already plans in place to offset that?
I think the retailers, the better ones at least, have definitely been planning for it. It was interesting, the day after the election, the way the market traded, and I know there was the Trump trade and everything went up. I think the market was up 2.5% that day. The retailers that have more exposure to China were down that day in a pretty big way. And so you saw that initial reaction. So I think the market is already starting to think that way. Who has more exposure? Where do they have to lighten up? But we cover quite a few companies that, there's an example I have where, several years ago, they had 50% of their product coming out of China. Today, it's 20. Actually, it's probably getting close to 20. It was 25% last year. It's probably 20-ish this year. So, you've seen the retailers move and reposition through the past couple of years, and I think we'll see more of that accelerate over the next 6 months.
Hey, Joe, it's good to hear from you, sir. Good stuff. Joe Feldman there of Telsey Advisory Group. That last point on some of the retailers, we talked about it on this program the day after the election. The market was up 2.5%. Dollar General down 5%. Got absolutely punished. And I think what we touched on there is so important going into 2025. Where you sourced your goods from, how you manage your inventory, it's going to be massive for these retailers through the next several months.
And you can tell that analysts are really poring over all of the inventory lists to understand exactly where things are being sourced, to get a handle of that beforehand. But it really does highlight, and I think your question is a great one, how much people have already prepared for this. They've gotten already a preview of this, so maybe it won't have the same sort of disruptive character that it did, say, 8 years ago.
Walmart in the pre-market is up this morning by a few percentage points. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Reuters reporting that Lebanon and Hezbollah have reached an agreement on a ceasefire with Israel. A representative from Lebanon's parliament, who Hezbollah allowed to negotiate for the group, said that the deal would call for no Hezbollah forces between the border with Israel and the Litani River in southern Lebanon. A U.S. official cautioned that negotiations were ongoing, with U.S. envoy Amos Hochstein arriving in Lebanon earlier this morning to continue discussions. The Biden administration is seeking $98.6 billion in emergency disaster relief aid from Congress. The funds will be used to address the devastation from back-to-back hurricanes Milton and Helene that slammed the southeast. The administration warned that agencies on the ground helping are running low on funds. In October, Biden said the damage from Milton alone could cost around $50 billion. The DOJ is seeking to force a sale of Google's Chrome browser. Sources tell Bloomberg that the department is asking a judge to impose AI and data licensing requirements on the company. It would be a historic crackdown for the tech company. In August, it was ruled that Google illegally monopolized the search market. Google says that the proposals would harm consumers and developers. That's your Bloomberg Brief. John.
Danny, thank you. More from Danny again in about 30 minutes. Up next on the programme, looking for safe havens.
Often investors overstate the tactical importance of geopolitics. Oftentimes the way to actually trade politics and geopolitics is to fade the risks.
Bonds getting bought this morning. That conversation up next. Bonds bid this morning. Yields are lower across the board on a 2-year out to 30s. The yen is stronger. Gold is rallying. Under surveillance this morning, looking for safe havens.
I don't think that Putin has a reason to overreact. That would be self-defeating. One of the things about geopolitics is often investors overstate the tactical importance of geopolitics. I actually think geopolitics and politics is far more important for your strategic asset allocation than it is for tactical. Oftentimes, the way to actually trade politics and geopolitics is to fade the risks.
We're fading some of that risk over the last few hours. So here's the latest. Global bonds climbing on worries over a new escalation between Russia and Ukraine. Markets rattled as Ukraine carries out its first strike at Russia using US missiles. Joining us around the table is Al-Hussainy of Columbia Threadneedle. Ed, good morning to you.
Good morning.
Lisa said it straight away this morning walking into the studio. This was an important test. Something bad happened and we bought treasuries. What does that tell you about treasuries as a haven?
Absolutely. I think the starting level of yield has made them that much more attractive in the course of the past couple of years. And I think the outstanding question is, it's 1 day's worth of price action. If we have a more significant drawdown in equities, can we hold on to those gains on the treasury side?
Well, there's sort of this larger question of what risk do they respond to? Geopolitics, you buy bonds. Inflation risk, absolutely not. Some sort of growth risk, yes, you buy them. Is this basically people looking for some sort of catalyst to just give them an excuse to take advantage of where yields are? Is that kind of how you're viewing this?
Maybe. I mean, I would say today the positioning going into this event probably plays a key catalyst. The rates have been selling off for a number of months now. Positioning is really on the light side. So on the duration side, there's a lot of room to fill. And I think that's the reaction we're seeing today.
On a broader level, how much are you basically fading some of the move that people are thinking? Maybe we're looking at a neutral rate closer to 4 to 4.5%. We're looking at a Fed that's going to cut into next month, but then after that, maybe pause for a prolonged period of time, maybe not even cut next month. How much do you lean into that versus push back and say, if you like treasuries at 4%, well, hey, you can get them now at 4.5%. So why not go for it?
I think it's a little bit of the latter. I think the conversation around the neutral rate probably changes too frequently for most investors. In my mind, the neutral rate is secularly determined. It's determined by productivity and trends that really don't move around that much. And the fact that Treasury yields, particularly on an inflation-adjusted basis, now are yielding 2+% at a time when credit and equities are quite rich, that's a really good setup to add and diversify into duration risk.
We're running a deficit of 7% at the moment, and things are pretty good at the headline level. In aggregate, unemployment's still around 4%. Does that undermine the risk mitigation characteristics of treasuries?
I think the key question is, will that fiscal situation devolve into higher inflation? That's the toxic mix. In which treasuries underperform. In 2022 was a fantastic example of this. We had some of these risks on the table in 2018 as well. I think the Fed has done a lot of work to take some of that risk off the table by being very aggressive, learning from their experience in 22, and front-loading some of the response to inflation. I think the odds of that happening next year are lower.
The supply side of the economy was constrained coming out of the pandemic. And then we basically injected steroids into the demand side, which produced some of this inflation. How much have things changed on the supply side now that would make it more difficult to generate inflation through fiscal spending? through deficit spending?
Yeah, absolutely. I think, look, ultimately, inflation is going to be mixed between fiscal and monetary policy. I think the supply side issues generally are temporary. Tariffs are a great example. They could be a supply side shock, but they will pass through. We need a fiscal response in the form of fiscal stimulus next year to really open the door to inflation. And we need the Fed to basically take a step back and be behind the curve. The odds of that combination, I think, are quite low.
If there's too much fiscal spending, do you think the bond market would push back?
That's the job of the bond market. We're going to reprice higher, and the cost of issuing that debt on the margin is going to go up. I think that's quite likely. Again, that's been the learning of the last decade, really.
We've been playing Bachelor, the Treasury Secretary version, and there's a real question here about the type of issuance that the Treasury does to fill that gap, how the Treasury has handled that recently, how it will going forward. If they increase their longer duration bond sales, do you expect the bond market reaction to be swift and notable?
I think it really all depends on the underlying economy, right? If the underlying economy is weakening and you put that duration supply into the system, no problem, we'll absorb it. If the underlying economy is still strong, risk assets are doing well, and you introduce that duration risk like we had at the end of last year, 2023, that's a really painful combination.
Does the Treasury Secretary pick matter to you? Does it change your view on where the emphasis of policy will be in the next 12 months? How influential is it?
Very limited and really on the margin. I think he's going to, or she is going to, influence the supply story.
I don't think there are any women that are nominated yet, so you could say he.
Well, we
Ramos
don't know.
Not in the running. Do you consider?
I can say that officially. I am not going to be getting a rose. Carry on.
I think the person's going to influence the supply story for sure. The person's going to have a voice in negotiating the tax policy changes, and of course a voice in the tariff policy. But on many of those issues, I think the course has been set by the president, and the Treasury Secretary is really not going to make that much of a difference.
It's something we said earlier on in the program. A lot of this policy is going to come from the top down, big time.
Yep, that's going to come from President-elect Trump, and those individuals he put in those places are going to just be there to really shepherd through the policies that he ran on, and he feels like he has a mandate now to implement.
Things have changed. No Dutta talked about this earlier on this morning. In the first term of Donald Trump, now President-elect, looking at a second term, we were looking at the Senate as a body that was going to send a bill to the president just to be signed. And now we're looking for the president to send a bunch of ideas down to the Senate for them to push through. And that's a big change.
Yeah, still people are struggling to understand seriously, but not literally, and to understand exactly which of the policies and how directly they'll be implemented. There have been a lot of stories around some of the picks that he's already had and how they wouldn't necessarily get confirmed. And then you have him basically coming out through different channels saying, yes, they are, because I'm going to make sure of it. I mean, there just is still a lot of uncertainty around what the agenda actually will be in implementation by President-elect Donald Trump.
If the picks so far are your North Star, it's both serious and literal, based on what we've seen so far. Al-Hussainy, thank you, sir, of Columbia Threadneedle. In the next hour of Bloomberg Surveillance, Emily Roland of John Hancock, Koesterich of Bloomberg News, Stephanie Roth of Wolfe Research, and Jitania Kandhari of Morgan Stanley.
Our base case is really that there will be a cut in December, a 25 basis point cut in December.
We have in our baseline that the Fed's cutting to 3.5.
They don't have to go too much further to be at the right rate for this level of inflation.
We're priced for strong growth and additional term premium.
The economy's in a really good space.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Two-part story this morning. Let's get to the first part first. Earlier on, 4:20 Eastern Time, a headline crossing the Bloomberg terminal. The Ukraine has struck inside Russia using Western missiles. That sent equities lower. We're recovering at the moment. Check this out. We're down 0.25% on the S&P 500. On the Nasdaq, we're down by only 0.1%. And in the bond market, yields were lower by about 5 basis points. This is what the Treasury looks like at the moment. The 2-year, 10-year, 30-year shaping up as follows. On a 10-year, we're down about 5 basis points, still at 436.28. As reports come out of Russia, Anne-Marie, that maybe the damage was pretty limited.
Right, but the knee-jerk reaction was immediate. And the knee-jerk reaction potentially we could see again if we see another iteration of this potential tit for tat, whether or not it's ATACMS going to the border of Russia and Ukraine, and then that rhetoric coming out of Moscow and this edit of this decree when it comes to the nuclear posture. The issue is front and center. Escalation is back. But also the market might be looking into this saying, is it escalation because potentially both these parties know that they may be forced to a negotiating table when President-elect Donald Trump gets into the White House?
That's the near-term story. Over the next few days, the attention's going to shift to the earnings in quite a big way. We'll hear from Target tomorrow, Nvidia as well. Earlier on this morning, we heard from Walmart, and Walmart looking pretty decent.
Yeah, really increasing their expectation for full-year earnings as well as just sales you're seeing across the board, them gaining share from the likes of Amazon, but also other retailers. We've been talking all morning, is this a Walmart story or is this a broader consumer story? We were hearing from Joe Telsey, it's a bit of both. Those shares up 3.6%. But putting these two stories together, the Target, the Walmart, and Nvidia, there's a real question mark. Are we going to see the proof in the pudding of AI and some of the technological advancements? Walmart is gaining because of their advertising, because of their online shopping networks, because of some of the tech aspects. Do we start seeing the application as the AI story actually starts to take hold?
That's the story for tomorrow afternoon. Equities right now in the S&P 500 down by 0.2% and recovering. Coming up this hour, Emily Roland of John Hancock as stocks move lower on geopolitical concerns. We'll catch up with Bloomberg's Threadneedle as Tesla moves on news that Trump will prioritize autonomous driving, and Stephanie Roth of Wolfe Research on the long-term impact of tariffs. We begin this hour with equities lower and bonds rallying as Ukraine carries out strikes in Russia using US weapons. Joining us now is Emily Roland of John Hancock. Emily, welcome to the programme. I want to turn to a quote that came from Lori Calvasina of RBC to kick off the trading week. And she said this about valuations and positioning and sentiment, that the US equity market seems to have little capacity to absorb bad news. What have we learned this morning on that front?
Well, we've seen a modest bid, John, for some of the geopolitical hedges out there. You know, you're seeing the dollar strengthen. You're seeing gold catch a bid here. Notably, oil prices are still looking at WTI below $70 a barrel. So we saw a big move, of course, yesterday. That's moderated a bit today. And then, again, a modest bid for treasuries here. I think the treasury bond market has been focused on nothing but the potential for pro-cyclical policies under the Trump administration. So you're seeing a bit of a shift here, but certainly nothing that's overly notable here, given the prospects for heightened geopolitical risk.
When you think about all these issues on the table at the moment, Emily, it just feels like it might be US driven. In this case, a decision to allow Ukraine to strike Russia inside Russia with US missiles, but it's Europe's problem. Likewise with tariffs. Tariffs ultimately Europe's problem. Does this just reinforce the view of US exceptionalism into next year?
Well, certainly that's what markets are telling us. We've seen massive outperformance from U.S. assets here. Again, that dollar strengthening trade. We've seen this almost speculative frenzy across risk assets in the United States, everything from cryptocurrencies and crypto-related assets to lower quality growth stocks. I think one of the things that we need to think about here is the consensus around the U.S. is so overwhelmingly positive right now. And when the consensus moves to one side of the boat, sometimes it can flip. So we want to think about, potentially fading some of the move that we've seen into more speculative assets and redeploying assets into higher quality, more defensive options here, given the massive run that we've seen in more speculative assets.
So, Emily, sell Tesla, buy 10-year Treasury yields?
Well, I think you got to own some of that stuff. Tesla's certainly come a long way. We look at, of course, the big event after the close tomorrow with NVIDIA's earnings. NVIDIA is the number one high quality stock. So we want to continue to embrace quality, and that's according to quality indices that we look at. We want to look for companies with great balance sheets, good return on equity, a good ability to maintain margins here. But I think the name of the game right now is really quality at a reasonable price. How can we think about embracing those quality companies but not overpaying for them? And so we're following the earnings. It's going to be really interesting to see if NVIDIA can once again deliver tomorrow.
Are we underestimating how much of a macro story NVIDIA is going to be? That basically this could be the main event of the week in a pretty significant way to send markets in a direction about if they can raise and beat in the same kind of way?
Yeah, I think it's just because of the sheer size of the stock, it's got to be critical. I've been spending a lot of time with investors over the course of the last few weeks, contending with some of the issues around for example, emerging market equities and what to do with those positions. I've gotten a lot of questions about, India, for example, and we've had those conversations, but it's like, look, NVIDIA is 20 times the size of some of these markets. So that's why it's so critical here to portfolios. Again, we want to be there because the earnings have delivered and it's high quality. We've got to think about diversifying that exposure and finding areas of the market that are still going to give us quality, mid caps, industrials, for example, but that actually are trading at more reasonable valuations.
Emily, in your notes, you talk about, and you're talking about here, that you push back against this consensus, this idea against higher inflation, higher growth narrative. Yeah. Then what do you look at when you think about these policies that potentially we're going to see next year, which many say they actually could be inflationary?
Well, Anne-Marie, I think potentially is the right word. And I think a lot of us have been saying the word potentially over the last couple of weeks here. We looked back at the last Trump administration, and yes, there were some different dynamics from a macro perspective, but core PCE, which is the Fed's preferred measure of inflation, averaged 1.7%. in the last Trump administration. If these tariffs are more targeted, you may see the impact to inflation be much more muted, maybe 0.1% per a lot of the economists that we've talked to about this issue. The impact of these potential immigration issues actually are going to possibly weigh on growth. So we're looking at some of the things that the bond market's really not sniffing out right now. For one, wage growth is coming down meaningfully. Job quit rates are down, which should put downward pressure on wage growth and corporate profits. Housing supply is increasing significantly right now, which should cause that tricky shelter component of inflation to finally moderate in our view. And then the commodity story, which we mentioned earlier, if you're expecting some kind of 1970s boom in inflation, that has to come alongside higher commodity prices. And we simply aren't seeing it now, especially given more muted demand out of China. So we think every backup in bond yields represents a nice opportunity to lean into the income that's available, which is now close to 5% on the aggregate bond index.
Two policy proposals you didn't mention I'd love to get your view on. The idea of we're going to see tax cuts at the end of next year, and also that this is a president that wants to see deregulation throughout the Washington complex.
Yeah, so the deregulation story, I think you're primarily seeing in the outperformance of financials. Regional banks are on an absolute tear. Same thing happened post the 2016 election. That trade lasted for a couple of months after the election and then basically moved sideways. Not to say there wasn't value there, but really the bulk of the outperformance came on the news. We're also looking at corporate tax cuts, potentially, and that was very accretive to corporate earnings. If you look at the S&P 500 next 12-month earnings growth, you saw a spike in 2017 once those tax cuts went through. So I think investors are betting on that. The challenge is a lot of this great news, whether it's continued stock prices running, whether it's the economy doing well, a lot of that is in the price on the equity side, with the S&P 500 trading at about 22 times forward earnings, 27 times trailing, which is as expensive as stocks have ever been, third most expensive in history. So we want to think about the fact that, can we get much more multiple expansion? We've just seen a massive bull market that was all driven by multiple expansion. Earnings have actually gone pretty much nowhere over the last couple of years. That's the reason we're thinking about bonds. We don't think that they're priced appropriately for what comes next. Stocks are already there.
Emily, I have to say, what I'm hearing from a lot of different investors is a desire to try to get out from under the whipsaw headlines of, the Treasury Secretary race and whether we will get tariffs and how much or how not to, and all of these kinds of things, and figure out what you can lean into that's just sort of a constant. Is that basically what you guys have been doing? How do we strip out the signal from the noise and really figure out our strategy independent of what some of these policies might be?
Yeah, and Lisa, you're right. It's tough, and it might be a little boring to people to kind of try to stay away from some of the conjecture and think about what really drives markets over time. You look at some of the relative performance under the last two administrations, and it's actually exactly the opposite of what you might have guessed. For example, under the Biden administration, the best performing asset class by far has been energy. Probably not what you would have thought, given the green energy policies that have been put in place. Under Trump, the first Trump, one of the best performing asset classes you could have owned was Chinese stocks. It's because we were in a period of global synchronized growth. That macro story was far more important than what was happening from a policy perspective. So we think if you can try to cancel out some of the noise, focus on earnings trends, focus what's happening from an economic standpoint. That's going to lead you to a better path forward as far as cross-asset performance.
We did just get Walmart earnings. We get Target tomorrow. We also get NVIDIA. We've talked about NVIDIA. Other than NVIDIA, is there an earnings story that you think is kind of a North Star of some sort of signal versus just simply noise?
Well, I think it's really about the broader story here, and the bar is just going up. You know, analysts are penciling in 15% earnings growth in 2025, and we think that's an awfully high bar given the fact that we're seeing decelerating growth trends. It doesn't mean that there aren't pockets of the market that can achieve that, but you've got to be really, really mindful here in terms of reaching too far for risk. And again, embracing those higher quality, more defensive options. We like areas like utility companies. We continue to like technology companies at a reasonable price. It's really about that internal market rotation and, frankly, finding an active manager that can identify those stories.
Emily, appreciate your time this morning. Thanks for catching up with us. Emily Roland there of John Hancock. Started that conversation on America first, quite literally in the equity market, US exceptionalism. There's a joke on Wall Street that Europe is good for vacations and not good for investing in. United Airlines seeing almost a 10% holiday travel surge to Europe year over year, a 30% boom versus 2019. European vacations surging on euro dollar at 105.
100%. First of all, tipping isn't as high as it is in the United States, although if you do, you get, a lot of really incredible
There's no
thanking. Right, but, if you are someone who is generous and wants to really appreciate that good service. Anyway, moving on. I just want to note that, who isn't thinking about going back to Europe if you're basically talking about parity and essentially a 10% discount on your entire vacation? Just saying.
One investor recently told me Europe is an open-air prison with fantastic food and great art.
Who said that?
Michael Purvis.
Geez, that's brutal. That is an open-air prison. You're allowed out. I'm here. I got out. You are allowed out. That's brutal. This came from United Airlines just moments ago. Rather brutal headline there from Michael Purvis as well. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Sources tell us that President-elect Donald Trump's transition team is considering former Fed official Kevin Warsh as Treasury Secretary and a hedge fund manager, Scott Bessent, as the director of the National Economic Council. Trump was expected to make a decision on the Treasury job last week, but infighting between Bessent and Cantor Fitzgerald CEO Howard Lutnick reportedly irritated the incoming president, delaying his decision. According to people familiar, Lutnick is no longer seen as a contender for the role. Nestle shares are selling off in the European trade, down 2%. It lowered its profit outlook and announced a cost-cutting drive. The new CEO set out his plan to turn around the world's biggest food company. That includes separating its bottled water brands into a standalone business. Nestle has been struggling to build back sales volume growth after relying on price hikes during a period of inflation. U.S. tech curbs are preventing Huawei from creating more powerful chips for AI and smartphones. People familiar say the current processors and design use the same architecture that's been around for years. The people say that Huawei will be stuck with aging technology until at least 2026. The stall also hamstrings China's broader AI ambitions. And that's your brief, John.
Hey, Danny, thank you. More from Danny again to wrap up the news in about 30 minutes' time. Up next, the morning calls, plus Bloomberg's Threadneedle as Tesla gets a big boost on a report that Trump will prioritize full self-driving. Their stock is down by 1/3% from New York. This is Bloomberg. The open about 1 hour and 13 minutes away. Equities negative by 1/3%. Let's get you some morning calls. First up, Piper Sandler downgrading Kraft Heinz to neutral, citing retail headwinds in the food service space. That stock is down 0.4%. Your second call from TD Cowen, raising its price target on United Airlines to 125, saying the airline is best positioned among its peers. That stock a little bit softer this morning, down 0.7%. And finally, Truist raising its price target on Nvidia to 167. The analyst expecting the chip giant to deliver better than expected earnings tomorrow. That stock is up by 1.1%. Let's turn to autos. Sources telling Bloomberg President-elect Donald Trump's transition team is looking to ease the framework for self-driving vehicles, a move that would directly benefit Tesla. The car maker's stock is up almost 35% since Trump's election victory. Joining us now, Craig Trudell of Bloomberg out of London. Craig, welcome to the programme, sir. I have a real frustration with this story and the rally off the back of it. I'm trying to work out what the biggest hurdle is here. Is it really regulatory authorities, or is it just coming up with a product that actually works?
I think Elon Musk would like the market to believe that this hurdle being in the way is a big impediment. Tesla's technology is not to the point where that hurdle is even relevant, and I think trying to spell that out to everybody makes for difficult work when you've got a company that, after all, markets its technology as full self-driving, despite the fact that it not being self-driving fully or otherwise. And so you have a company that has been extremely aggressive in how they've marketed their technology for years, have overpromised and underdelivered, but have managed to sort of bluff their way to a really rich valuation on the basis of let's be fair to the company. They do have quite competitive driver assistance technology. So I think that's important to acknowledge, while also acknowledging that they do not have driverless cars to be approved at the moment.
Craig, there is this theory that if some of the trials were allowed, if there were some areas that could be test zones for fully self-driving vehicles, that you could get to a technological advancement level that would allow this to actually be a reality. My question is Tesla the best position for that, or some of the other car manufacturers in the U.S., I'm thinking of GM or even Ford, basically at the same place?
Yeah, there's a really intense debate within the industry about how exactly to go about, trying to bring this technology to market, right? You have, companies like Waymo or Cruise, the GM unit, that have tried to kit out vehicles with really expensive hardware, really equip them also with really, intensive ability to process the data that comes in from those cameras and sensors. The radar and LiDAR sensors that are quite expensive, and to deploy those vehicles in sort of set areas with really sort of defined limits in terms of where they can go and can't go. That has proved effective at least getting these vehicles onto the road and getting them to the point where they're able to start charging fares for rides. They've clearly have a head start on Tesla in respect to commercializing in that regard. What Musk is trying to prove is that no, you don't need all these expensive pieces of hardware. We just need to sort of over time improve my driver assistance software to the point where people don't have to pay attention, and eventually we'll be able to take the driver out. And he's pretty out there in terms of being of the view that can be accomplished, at least among folks who have been in this field a long time. They're quite skeptical of the possibility that you can sort of take shortcuts with respect to how intensive the compute you need is. Also the sensors, whether or not Tesla can rely just on cameras and safely deploy this technology, I think very much remains to be seen.
Craig, what is the model? Is it for the car manufacturers to sell these self-driving vehicles to the likes of a Hertz or an Avis or some sort of car rental company to kind of manage the platform, or are they going to ultimately become direct competitors with the likes of Uber and basically operate an entire system of self-driving vehicles that people can subscribe to?
I think this is also another aspect of this story that's really interesting, this sort of intense debate of will they or won't they being Tesla, need to turn to Uber or Lyft eventually. Musk has sort of, alluded to this idea that he will launch a competitor to an Uber and basically offer, a sort of half Uber, half Airbnb type model where, in the same way you use Airbnb to loan out your home, you could loan out your car to a Tesla ride-hailing app and make money off your car when you're not using it. We've seen, however, that Waymo and Cruise, they have recently done deals with Uber actually to deploy onto that app because of the expertise and capabilities that Uber can bring to the table with matching ride demand with cars out on the road. And this is not something that is so simple. It sounds like something that a Waymo or a Cruise would be able to build up that capability, but they've learned through experience that it would work in their best interest actually to leverage what Uber can bring to the table. And I think if you talk with Adar Khosrowshahi about the likelihood that Tesla eventually gets there, I think they are sort of quietly confident that Tesla will find that this isn't as easy as Elon Musk is sort of leading everyone to believe.
Well, Craig, even if there's appetite from President-elect Trump because of Elon Musk to have this federal framework, it would have to go through congressional approval. So is the market just liking the idea that this man, Elon Musk, the CEO of this company, has proximity to power?
I think what this speaks to for the market is just a few weeks ago, Elon said he wanted this. A few weeks later, the election goes his way, and we're learning that this is a priority for the Department of Transportation. That speaks to this idea that absolutely he has Trump's ear. We don't have to even sort of rely on reporting to know that. We see him next to Trump on a daily basis. We see him at ringside at a UFC fight, at Mar-a-Lago on a sort of daily basis on his plane. So I think that the market is sort of betting that surely this is going to pay off for Musk in the long term. Of course, we also need to sort of maybe temper our enthusiasm for that based on the way in which people who have gotten close to Trump have managed to find themselves on his bad side sort of at a moment's notice.
Had a massive move on that stock over the last week. Craig, appreciate your time, sir. Craig Trudell of Bloomberg. That stock is down this morning by 0.7%. This closeness, this relationship that the president-elect has with Elon Musk has been a big fuel for this stock over the past few weeks, few days.
Yeah, and the proposal that was highlighted by Bloomberg about the idea of a better regulatory framework to get autonomous driving vehicles on the road, really kind of turbocharging that. There are a lot of potential hurdles, and you have to wonder if it's going to help electric vehicles. You have to imagine it probably would help other auto manufacturers as well, unless there's a special carve-out just for Tesla.
One massive hurdle is going to be, if this is going to be federally regulated, it has to go through Congress on a bigger scale. But that proximity to power, President-elect Donald Trump's going to Texas today with Elon.
Stock has been up big time. Up next on the programme, some breaking housing data. We'll get that for you. And we'll catch up with Stephanie Roth of Wolfe Research and Jitania Kandhari of Morgan Stanley. From New York, this is Bloomberg. Equity futures right now on the S&P negative by 0.4%. On the Russell, we were down by more than 1%, recovering just a touch. We're off by 0.7. In the bond market, going into a sprinkle of economic data, 10-year yields are down by 6 basis points now, 4.35 on 10s, on 2s down by 5, 4.22. As we await numbers for housing starts and building permits, Mike McKee is with us around the table in the studio. He has that data right now. Good morning, Mike.
Good morning. Well, it's interesting you say a sprinkle of economic data because, of course, this stuff was infected by the hurricanes. But we do see a slight decrease, not a huge decrease, but 1,311,000 is the rate at which we are building housing, or at least new starts. Building permits are 1,416,000. That's down from 1,425,000. This is a 3.1% decline for housing starts and a 0.6% decline for building permits. And basically what we're looking at here is the hurricane effects. You can't build when everything is torn up. However, we are going to see a rebound from that in the future, so you can expect some good news. And the big question is, this is not the housing data that's going to really matter because of the hurricanes and the rebuilding, but wither real estate. The Fed cuts rates and mortgage rates don't go down. they go up. We did see a slight increase in home builder confidence yesterday.
Yeah.
But everybody's wondering, what's it going to take to get the real estate industry going?
Yields are lower this morning, at least, at the long end of the curve. At the front end as well, we're down 5 basis points on a 10-year. It doesn't really matter what we think about what's driving this. Of course, it does matter what market participants believe it is. It also matters what Fed officials believe is happening too. What's your takeaway on that? Why do Fed officials think that yields are up, that mortgage rates are higher, even though they've been cutting interest rates? What do they think is behind that?
They don't want to give a specific reason in public because of the political aspects of it. But basically, they think the markets are reacting to what we're going to see in a new administration, that we're getting some inflation priced in, whether or not it happens. You're getting the uncertainty premium and you're getting inflation priced into these numbers. But the Fed admits there is a problem with housing, in that housing mortgage rates got so low when the Fed was holding rates at zero, that it's really hard to dig out of that because people don't want to change. And the costs of changing and moving into a higher mortgage, normally you get the people who are retiring moving out of their houses and everybody can move up. But people don't want to do that because even if they buy a condo that's cheaper, they're still paying a much higher mortgage rate.
Housing has been a huge kind of quagmire in terms of the driving forces and why prices haven't come down and why you aren't seeing more volumes. Just some of the straight inflation numbers, though, are really interesting. And I do want to bring this up because it came out at the same time and it's catching a lot of people's attention that Canadian inflation accelerated to 2% year over year in October versus the estimate of 1.9%. And I know that there's very much of a housing focus, but I wonder how much people are looking elsewhere outside of the U.S. to understand the global dynamic, or is it completely inward looking when it comes to the Fed and some of the economic data?
Well, it's somewhat inward looking now. You look at what's happening in Europe, and I was thinking of this morning when you look at inflation in Europe rising a little bit, and yet everybody's still predicting that the ECB is going to not only cut rates, but accelerate the cuts because of the impact on the euro from the Trump administration. And so what the U.S. is doing is driving the European housing market. Because mortgage rates there are going to be able to go down much more easily. Because of the structure of mortgages and the 30-year lock-in in the U.S. and in Europe, you're looking at 2-3 years at a time. So right now, when rates were going up, that was a bad time to be trying to buy in the UK or in Europe. And now going down, things will be better for them than for us.
When I first moved here and I saw Canadian payrolls drop across the Bloomberg terminal, I asked someone, do people care about the data in Canada? And someone just turned around and said no. And since then, for the last decade, I've barely touched Canadian economic data.
Do we really have to do this again? I care about Canada. I'm speaking to the Canadians.
I didn't say I don't care about Canada.
I think Canada is important. I respect it as a country. And I think that the inflation numbers are important as well, because it came in at 2% versus 1.9%, which really highlights that the global trend isn't as clear as people previously thought. Canadians, I've got you.
I think we're extrapolating things out a little bit too far. I love Canada. Just talking about the economic data. Michael McKee,
I'll give you one funny number here. We would expect a decline in the South for housing starts. Single-family starts down 10.2%. Single-family starts in the Northeast, where we are, down 28.7%.
Wow.
And we haven't had any rain for months.
Yields are down at the long end by 7 basis points now, 454 on 30s on 10s, 435, 434.92. With us around the table is Stephanie Roth of Wolfe Research. Stephanie, good morning. Any reaction to this data so far?
Yeah, I mean, it's an interesting one. And like Mike just said, the weakness came from the Northeast, which is kind of interesting. It bounced back. It came weak after a strong month in September. There's just a lot of sort of noise going on in the data. I think what we're going to see is the housing market's going to have trouble bouncing back with mortgage rates having increased after even the Fed has been cutting.
Why do you think rates have been going up even though the Fed's been cutting?
It's all about the election. And it's all about the market. Certainly, the market trades Trump as a yield curve steepener. We've seen that to some extent. There are concerns about the deficit. I don't think that's the primary driver. I think it's the markets getting excited about a better growth outlook. And for 2025, I think that's fair. For 2026, I'm worried about the tariff impact on the economy.
Okay.
I'm trying to understand this. So if yields go up, makes mortgages more expensive, makes it more difficult for people to afford homes because prices aren't necessarily coming down. At the same time, we saw confidence yesterday among home builders rise to the highest level going back 7 months. And this whole idea is, well, because of the election, regulations will get stripped back and the economy will be doing better than it otherwise had been. So which is it?
I think there's an element of this animal spirits coming back. So you saw for NAHB, it was driven by expectations. Last week, we saw Empire Fed increase a 3 standard deviation move. There's probably an element that people are feeling better about the outlook, right or wrong, but that actually has an important impact for the economy. And I think that's what's going to be driving an above trend growth for next year until we start worrying about tariffs again. Probably not till the end of the year.
But why do you think the worry for tariffs comes at the end of the year of 2026, when that is the one thing we know that Donald Trump can do unilaterally?
So our base case is that, one, he probably wants to play this game with a number of the different countries like he did last time, have a number of meetings, throw out the tariffs. We also think he'll probably want to attach it to some sort of investigation, which will require a comment period. And it makes sense for them to tie it to extending TCJA, whether or not they explicitly include it in a bill or there's a handshake deal about let's include the revenue savings for this bill. It makes sense for them to do it around the same time.
If they're connected to the tax bill, what is the true objective of these tariffs?
I guess it depends who you're asking. I mean, I guess from Trump's perspective, there's 2 benefits. I think they're pretty risky, but from his perspective, there's 2 benefits. 1, you can stick it to China, and 2, they can raise trillions of dollars on these tariffs, at least the way if you assume sort of static estimates here.
So you see both the good things and the bad things that the market has to digest when it comes to Trump policy being connected in terms of he wants to extend TCJA, he wants more tax cuts, and he's going to say, I'm going to pay for this with tariffs. So they all get rolled out at the same time. So the sequencing is actually in parallel.
Yeah, kind of. I think for now it's a better growth outlook for 2025, better confidence, and then we start getting into the 2026 tax cuts. And then I think it's a negative for the market because at that point it's tariffs. And by the way, the tax cuts aren't really that large, right? They're expensive, but it's really just extending current policy. The incremental tax cuts that we're projecting is something like $500 million, which isn't that big. It's things like no tax on tips or a very narrow corporate tax rate cut, which is really just for domestic manufacturers. The rest of it is just a very expensive bill to extend TCJA, which is not a stimulus for the economy.
So before we get there, and going back to home building, because I'm still trying to wrap my head around, okay, you've got the tariffs and how this affects inflation. I'm trying to get back to, does this cause a revival in the housing market at a time where everything that you just painted does not suggest interest rates going down that much at the long end? Can you see a revival in housing, in some of the basic staples that people have been basically complaining about that they don't have access to? Can you see a revival if you have mortgage rates that stay at these levels?
Probably not. It's a tough one. I think the part of the economy that's going to do better is on the CapEx investment side. So less about housing. I think mortgage rates are still going to be a bit of a headwind. Could see a bit of an improvement. The builders are excited from the regulatory front, and that's fair. But I think the bigger stimulus for the economy is going to be on the corporate investment side, because that's where the deregulation is going to be important and the sentiment is absolutely critical.
Before you go, December, pause or cut?
It's a tough one. Base case is that they're going to cut. But I think it's fair for the market to be pricing 50-50. The most important thing is going to be payrolls. And we'll get a hint of that today when we get state employment at 10.
Payrolls coming out a little bit later, December 6th in the next few weeks, and then December 11th for CPI. That Fed decision December 18th. Stephanie, good to see you.
Good to see you.
Thanks for catching up with us. Stephanie Roth there of Wolfe Research. Let's check out the price action. A story of 2 headlines over the last several hours in the equity market. Futures are down by 0.5% on the S&P 500. Likewise on the Nasdaq 100. We dropped big time on the Russell 2000. The small caps down by 0.9%. We were down by more than 1 full percentage point earlier on this morning, initially following a headline that dropped at about 4:20 Eastern time, indicating that Ukraine had struck inside Russia for the first time using US missiles. Then we got a report, Lisa, out of Russia that maybe the damage was pretty contained.
Yeah, and there was more discussion around really how much is Russia going to go after with nuclear weapons, go after Ukraine, and I guess some of that has faded. What's interesting to me is that it's faded when it comes to the sell-off in equities. It hasn't faded in the bond market in terms of the bonds, the bid into bonds. So is this just basically an excuse? Can we make anything of this, or are we basically just tying ourselves in knots trying to create narratives at a time that's very messy?
Am I getting hate mail from Canadians now because of you? you?
I'm just getting love mail because of, my real recognition of Canada and the importance of Canadian economic data. I just want to say thank you and, appreciate your existence.
I'm Jonathan Ferro, and I endorse that message. Joining us now, Jitania Kandhari of Morgan Stanley. Jitania, good morning to you. We'll leave the Canadian story right there. I want to talk about this bond market. Yields are lower. We're down 6 basis points across the curve. We're down almost 7 at the very long end of the Treasury curve. The equity market rally has stalled more recently. Is the election shaping up to be a Southern news event, or is it still a little bit too early to make that call?
I think it's a little bit too early. There is a lot of the Trump trade that has already been discounted. I think focusing on fundamentals is key. And for me, when the 10-year yield reaches a real rate of 2%, that is tightening in financial conditions. Just given 2-year on real rates will be very heavy for an overly indebted U.S. economy. So I think there is anyways a mean reversion trade at 4.5% plus in the 10-year.
So are you buying 10-year or are you selling stocks?
So I think we're really fundamentally driven. So we do like stocks at this point, clearly because, again, if you think about what's happening on the tariff side, I think there is too much linear thinking in the market that Trump equals inflation equals tariffs equals all the issues that the market's pricing. And I think you really need to be discerning. We definitely like certain structural pockets of the equity market, whether it's financials, whether it's industrials with the industrial recovery in different segments like defense, electrification, automation, and also within technology, there are changing trends between the semis and also on the software side. So clearly in stocks, we like the 60-40 allocation even at this stage, along with alternatives which give you good geopolitical hedges, be it gold or be it even energy, which can be a nice hedge in the portfolio.
So we can get to the whole 60-40 and the idea of why bonds still offer that offset. But before we get there, you're talking about sectors and being very strategic and looking at fundamentals. This year, the fundamentals were GLP-1s for a hot second. That was going to totally transform the world and that we all were going to be skinny and fabulous and we're going to eat. And then there was this idea of AI and just the overlay. What are the narratives going to be that are going to drive some of thematic investing in 2025?
Yeah, so I think it's firstly, we need to understand the IT space, right? The technology space. The theme has been semiconductors, semi-equipment, because they are the picks and shovels and they lay the infrastructure for this new technology revolution. Now, also understand that these are some of the stocks that have come under the tariff war. So it's time to really move into some of the defensive parts of technology, which is software. Where will the value accretion and creation happen with all the infrastructure laid down by the semiconductors? So whether it's cybersecurity, whether it's industrial software or enterprise software. So we're beginning to kind of pivot towards some of the software names. The industrial policy in the world has secular legs, whether it's defense, which is a nice geopolitical hedge, electrification, which is, we are in a power deficit world. Everywhere you go, there is a power deficit, whether you want to build semis, whether you want the data centers, you want industrial automation. We can clearly be invested in secular power or electrification.
So you see opportunities besides U.S. exceptionalism? You see opportunities in global equities?
We see, yes. Even within the U.S., as I said, there are opportunities outside the leaders of the last decade, whether it's financials, as I mentioned, even within the overall software space, we're beginning to see differences.
So where around the world?
So I'd like to say one thing. So let's think about where does U.S. have trade deficits with, right? It's China, it's Mexico, it's EU. These areas will be volatile. Actually, volatility gives opportunities. Where does the U.S. have surpluses with the countries, right? It's UK, it's Australia, it's Singapore, and many other countries. Some of these spots look pretty okay and not volatile. UK is a market we're beginning to like, and we talked about it last time as well. Given EU will want a deal with UK, US has a unilateral deal with UK. UK is going to try to do all it can on the export side. They can't do much on the fiscal side. And generally, a lot of the negatives are behind them. Emerging markets, I mean, they are benefiting from the China-US trade war and some domestic demand economies that are not really geared to the export and global trade side of the world, be it India or be it pockets of like Indonesia. Lots of interesting opportunities. And as I said, in Europe, we really like the industrial theme because it really plugs into all these global secular trends that have legs.
Jitania, it's good to see you. To catch up, thank you. Jitania Kandhari there of Morgan Stanley. Some relative outperformance in the UK. As we mentioned, the FTSE 100 only down 0.4%, with the rest of Europe getting hammered. The DAX in Frankfurt, Germany is down about 1.3%. With an update on stories elsewhere with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Walmart shares are up 3% pre-market after it posted a beat on its top and bottom lines. It boosted its outlook for the year, citing strong demand from U.S. consumers across the income spectrum seeking value. Households making $100,000 a year or more drove a significant portion of the company's growth. Customers bought more at each visit. The company also saw strong growth in e-commerce. Online sales now total about 18% of Walmart's total business. Blackstone has agreed to buy the sandwich chain Jersey Mike's, confirming earlier reporting. Financial terms of the deal weren't disclosed, but people familiar said the value stands at about $8 billion, including debt. The company said that Jersey Mike's founder and CEO will maintain a significant stake, and the deal is expected to close early next year. Super Micro shares rallying some 23.5% pre-market. The server maker has hired a new auditor and filed a plan to come into compliance with NASDAQ listing requirements. If Super Micro's plan is accepted by the exchange, its new deadline for the document will likely be pushed to February. It will be able to stay listed on the NASDAQ until a final decision about its compliance is made. That's your brief. John.
Hey, Danny, thank you. Some headlines just crossing the Bloomberg terminal from the Russian Foreign Minister Sergei Lavrov, speaking from Rio, saying this, that the strike earlier on this morning is a signal of escalation. Lavrov going on to say, I hope the West will study the Russian nuclear doctrine. Bond yields near session lows. More on that story in just a moment when we catch up with Bloomberg's Ollie Crook, live from Europe, from New York. This is Bloomberg. The opening about 38 minutes away. Your trading diary, the calendar shaping up as follows. Today, you get some more Fed speak from Schmidt. Tomorrow, more remarks from Cook and Bowman, plus earnings from Target and the big one, Nvidia. On Thursday, we'll get another round of jobless claims and more comments from Goolsby. On Friday, S&P global PMIs and UMich consumer sentiment. As we count down to that opening bell, equity futures near session lows. Bond yields down 7 or 8 basis points as we all keep an eye on the latest out of Ukraine as the country carries out strikes in Russia using US weapons. Bloomberg's Ollie Crook joins us now for more. Ollie, good morning to you. What's the latest from the region?
Yeah, absolutely, John. So this is the first attack that we've got since Biden gave that sort of consent for the Ukrainians to use those American-made deep-range attack weapons within Russia. But the question is where this was basically permitted to strike. The real ambiguity comes around the fact that this was not struck within the Kursk region. This is what has raised a few eyebrows. This has gone a little bit further into the sort of Ukrainian, into the Russian field. This is something that is potentially concerning a lot of people, potentially when you have also Sergei Lavrov, the foreign minister of Russia, speaking right now at the G20 summit, saying that the use of the signal is a signal of escalation. He hopes that the West will be studying the Russian nuclear doctrine. The reason that he mentions the nuclear doctrine is because within minutes of these reports, we also got an update from that nuclear doctrine from Vladimir Putin, signing it into law, signing a decree that allows Russia to fire nuclear weapons in response to a large conventional attack on his soil, saying that Kremlin will view aggression against Russia by non-nuclear state-backed as a nuclear power, as a joint attack, not really drawing that distinction between the two things. So if it is just the Ukrainians striking with the American forces, this is something that Putin will consider potentially under this new doctrine a joint attack.
We also have Sergei Lavrov saying Scholz's position on Taurus missiles is responsible. Oliver, how divided is the German and U.S. stance right now?
What is very interesting about the German stance is that it has been basically follow Biden, follow the United States from the very beginning. At first, the Germans did not want to deliver tanks. The second that Biden said, okay, we will deliver tanks, the Germans followed. That has been basically the pattern throughout this entire conflict. That has changed over the last few days, where Biden has allowed for these ATACMS to be deployed by the Ukrainians within Russian territory. Scholz has been asked about this at the G20 meeting repeatedly over the last few days. He says, no, this is where we draw the line. I just spoke to a German lawmaker earlier today, just a few hours ago, saying that he basically completely disagrees with Scholz's position, and that is also not the position that is held by the CDU, Friedrich Merz, in opposition, who is likely to become the next chancellor of Germany, who has said from the very beginning that there need to be these deliveries to the Ukrainians to strike within Russia. Of course, what hangs over all of this for all the policymakers here in Europe is the Trump presidency, and what say will they have in the sort of end of this conflict, potentially this resolution, and this at a time where you have this sort of German government in complete upheaval and real disagreement on how to move forward. And potentially, before this election, the Bundestag could move to deliver those missiles, even in opposition to the chancellor himself.
Oliver, just quickly here, I'm wondering, what is the level of fear among some of the German lawmakers and other Europeans you're speaking to about the use of nuclear weapons?
Well, it will just really depend on the different parties. So you have, I think, the majority of the mainstream parties, with the exception of Olaf Scholz's party, the SPD, who are saying, listen, we need to be strong. We need to, in the face of the sort of the attacks of the Russians, you need to make these deliveries. There are, however, on the fringes, the far right and the far left. And these are two groups within the sort of German political system that have really gained in importance going into this election. They do not want to see more involvement in Ukraine. They want to see it sort of step back, and they want to see the German government get basically disentangled, and they're going to be increasingly a part of the conversation in domestic politics here in Germany.
Ollie, appreciate the update, sir. Ollie Crook there of Bloomberg out of Berlin this morning. Stocks near session lows were down 0.9% on the S&P 500. Coming up tomorrow, your lineup looks like this. We'll catch up with Julian Emmanuel of Evercore. We'll speak to the former World Bank President David Malpass about the race to be the next Treasury Secretary. Pierre Farragher of New Street Research looking ahead to Nvidia earnings after the bell tomorrow. And we'll speak to Matt Lazzetti of Deutsche Bank as this bond market receives a rather large risk-off bid. Yields are down 7 basis points on a 10-year, 434 from New York. This was Bloomberg Surveillance.